can. It may be further from the offices, further from downtowns, but that's okay now because we can work sort of, we don't have to go in every day, so we can work further from the office. So, I think people are buying wherever they can at this point.
And Selma, where are you seeing the demand? Is it more in the single family space or the apartments and the multifamily side?
Well, yeah, so I mean, we always see more interest in single family, particularly as households grow. There's kids, and two-person or three-person households. So there's always more demand for single family homes. But what's interesting is that the attached housing, so that would be condos, are now appreciating at the faster pace than detached homes. And that's because during the pandemic, there was not a lot of demand for attached homes. People didn't want to be in density and close to each other. So now a lot of the home prices for condo type housing is appreciating at a faster pace. It's catching up to all the growth that single families saw during the pandemic.
In terms of new home construction, is anybody building starter homes? Because it feels like when I drive around and I do see new homes being built, they're kind of the McMansion, and the builders tell me, well, that's where the profit margin is.
Right. Yeah. I mean, that's a difficult one because, we talked about this before. It's very costly to build a home at this point. Land is more expensive. Materials are more expensive. Labor is more expensive. So, builders have to find profit margins where they can. But I think there is a genuine effort. And given that the demand is concentrated in starter homes for starter families, I think they're genuinely trying to create that type of housing. And so now there is a lot more interest in, duplexes, 2 to 4 units, or, row housing and stuff like that. So I do see effort happening in that for that type of housing. Yeah.
All right, Selma, thank you so much for joining us once again. Always appreciate getting your thoughts and perspective on the residential housing market. Selma Hepp, Chief Economist for CoreLogic. Again, you see some new home construction, but it just, what we hear from the experts is we need a lot more of it.
A lot more, yeah.
Yeah, interesting. And so if you're in a place that doesn't build new stuff, like Manhattan, it can be a little dicey.
Yeah, been dealing with that myself these days.
Exactly. Well, maybe you have to go to someplace in the Sun Belt where they're building new homes or something. But then
got to go where the Bloomberg office is.
That's right. All right. S&P 500, it is down 1.2%, accelerating that sell-off. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
All shares of DoorDash are down more than 1.5%, while investors await second quarter results coming out today after the bell. Bloomberg's Charlie Pellet has more.
Investors will be focused on what impact rising prices are having on customers' willingness to shell out a premium for takeout. Rival Uber reported its delivery bookings grew 12%, with monthly orders per customer at an all-time high. Still, the supercharged growth in food delivery has tapered from pre-pandemic highs. Analysts surveyed by Bloomberg are looking for adjusted earnings per share of 30 cents on revenue of $2.05 billion.
Thanks, Charlie. There's a trend of people using diabetes drugs to shed pounds, but employers are now moving to shed costs. More on that from Bloomberg's Joan Doniger.
There is a limit to the weight loss people are seeing from those diabetes and other drugs shown to help you take off pounds. That limit is what your boss will pay. The Wall Street Journal reports so many have turned to drugs such as Ozempic to lose weight that some employers are cutting off insurance coverage because their bills are skyrocketing. Spending on the drugs can top $1,300 a month per patient. For insurance plans, that comes to tens of millions of dollars.
Thanks, Joan. Nobody won last night's Mega Millions drawing, but Krispy Kreme is offering a sweet consolation prize. Bring your losing Mega Millions ticket to a Krispy Kreme today for a free glazed donut while supplies last. By the way, the next Mega Millions jackpot estimated at $1.25 billion. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets coming up right after this.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Molly Smith, Paul Sweeney here in the Bloomberg Interactive Broker Studio. A sell-off in the market today. I guess that's what happens when a rating agency downgrades your government's economy. They're off 1.25% on the S&P 500. NASDAQ off almost 2% here. Seeing the VIX pull out is up 15.5%, up 2 full sticks. We're now above 16 on the VIX, so volatility coming back into the market on the yield front. Lots of movement there. The 10-year Treasury up about almost 9 basis points, 4.11% on your 10-year Treasury note, so that is a noticeable move there. Pullback in crude oil, WTI crude oil off 2% after that big move up off of that 67 level about 5 weeks ago. We're now at $79.73 per gallon. Right now, let's head down to Washington, D.C. We'll get world and national news, and we will do that with Amy Marrs.
Thank you, Paul. Another indictment filed against former President Donald Trump, the third since he's left office. This one is tied to the Capitol attack and efforts to overturn the election. Special counsel Jack Smith called the insurrection an unprecedented assault on American democracy.
It's described in the indictment. It was fueled by lies. Lies by the defendant targeted at obstructing a bedrock function of the U.S. government, the nation's process of collecting, counting, and certifying the results of the presidential election.
Special counsel Jack Smith says Trump is to appear in court on this new indictment at 4 p.m. tomorrow. The U.S. has been stripped of its top-tier credit grade by Fitch Ratings. Fitch cut the U.S. one level from AAA to AA+. We talked with Bloomberg Markets reporter Valerie Teitel.
There's been a lot of criticism by commentators about why Fitch chose now to do this downgrade, but they do bring up a lot of good points, I guess, when it comes to the U.S.'s fiscal position deteriorating.
Bloomberg Markets reporter Valerie Teitel says interest payments to service the debt have nearly doubled since the start of the pandemic, and the fiscal deficit is wider than it's ever been outside of a recession. A Northrop Grumman Antares rocket blasted off from NASA's Wallops flight facility last night.
3, 2, 1.
There it goes. The rocket carried a Cygnus spacecraft with a payload of supplies for the International Space Station. The mission will examine fire protection aboard spacecraft and the density of the Earth's uppermost atmosphere. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Paul and Molly.
All right, Amy Marrs, thank you so much. We appreciate that. Molly Smith here with me in the Bloomberg Interactive Broker Studio. You're in the New York City apartment market, are you not?
I am. It's a terrible place to be right now.
So you're trying to buy something.
I am,
And
yes.
not a lot of inventory like Selma Hepp from CoreLogic was talking about?
Yeah, she knows her stuff.
Yeah.
I can confirm. Yeah.
So from firsthand, okay, so, I mean, is it, I guess the same thing here? People just don't want to play that interest rate arbitrage where I'm probably sitting on a mortgage rate of, 3-4%, and I don't want to have to go into the world of 6-7%.
Yeah, that good old lock-in effect is, I would say it's pretty real. I'm trying to look at, one-bedroom condos right now, mostly in the Upper East Side, and there's just really not a whole lot out there.
And what does, roughly speaking, broadly speaking, in your experience, have you found, what's the market rate or market cost for a one-bedroom condo Upper East Side?
Plus or minus $1 million, probably.
What?
It's a scary.
You want to get
granted,
to buy one bedroom on the west side was $105,000. I thought that was outrageous.
Yeah, but that was back in the Truman administration. I mean, it's
that bad far back.
Also, reminder: this is condo versus co-op. So
what's the difference?
So
for those
a condo is where you actually own your property. A co-op, you own a share in the building.
Okay.
So
what's better or what's more valuable?
I mean, it depends on what you really want. And for me, I'm hoping.
Condo.
Okay, well, John has an opinion.
Okay.
Yeah, I believe I'm looking for condos because I'm hoping this will be an investment property that I can sublet it out after I don't live there anymore. Co-op's more stringent on the ownership and subletting.
All right. So do we have any flexibility on location in the city, or is it Upper East?
That's just kind of where my home is.
All right, I got it.
And it's close to HQ right here.
Home to HQ, that's right. All right, well, the ongoing real estate woes of one, Molly Smith. More coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to get the latest on the latest of President Trump's indictments. We're going to do that with Joe Matthew, host of Bloomberg Radio Sound On and Bloomberg Television's Balance of Power. He's in D.C. He's got his finger on the pulse. Plus, George Patterson, CIO at PGIM Quantitative Solutions, give us his market call. Then Tim Craighead, Senior European Strategist and Director of Research at Bloomberg Intelligence. He's going to give the second half outlook for the UK markets here and see what he thinks about this Fitch rating on the U.S., see what they feel about that over the pond, because he's based in London, originally from southwestern Virginia, but now ensconced in London. He's our go-to guy there. John Tucker, though, he's our go-to guy here. He's going to give us a Bloomberg Business Flash.
Sell-off in stocks getting a little worse right now. Technology shares leading the declines right now. In the S&P 500, you have information technology worst performing major industry group. Blame it in large part on rates. The 10-year Treasury yield has jumped to 4.12%, so that's up almost 10 basis points right now. It comes after you had the data from ADP showing the resilient labor market in the U.S., the Treasury saying it's going to sell more debt, and as Fitch cut the U.S. credit rating one level from AAA to AA+, and at State Street Global Advisors, Altaf Kassam finds the timing of the Fitch announcement a little curious.
If you look at their announcement, there's no real new information or insights in it, so we wouldn't be advising investors to change their behavior on the back of that.
Well, Pinterest dropping after saying it said revenue in the current quarter will rise in line with estimates. Disappointing some of the investors. The digital ad rivals posted surprisingly upbeat results last week. And then you had CVS, that is higher, beating estimates for second quarter profit as well as sales. All right, let's look at the NASDAQ 100 right now, 2% lower, down 315 points. The S&P 500 down 57 points. That's a decline of 1.25%, 45.19 on the index there. The Dow Jones Industrial Average, 260 points lower. That is down about 0.7%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. And that's your Bloomberg Business Flash, Molly and Paul.
All right, John Tucker, thank you so much. We appreciate it. Molly Smith, Paul Sweeney, live here in a Bloomberg Interactive Broker Studio, and we are streaming live on YouTube. Just head over to YouTube and search Bloomberg Global News. Here's a pitch that just came from a PR firm. AI-powered grocery service to announce 67% year-over-year revenue growth. Are you kidding me?
Just put AI on any name. Pets AI.
Yeah, sure. I can take that public. Go figure. Our internal chat here, folks, in the Bloomberg Radio is just exploding with the relative merits of living on the Upper East Side versus the Upper West Side, and it's just fascinating for those of us who don't care. But anyway, let's bring in Jess Menton because she's always important, and we always value her opinion in here. She covers the markets here. Jess, we got a sell-off in the marketplace. I guess Fitch has a pretty big role to play there. What are you seeing in the market?
Well, when I'm speaking with my sources, they're very careful to note that they would have been a bit more concerned had this been, say, Standard & Poor's or Moody's when it comes to that, because that would obviously have more moves when you're talking about what's happening in the bond market, and that would have to make things reprice when you're talking about specifically the stock and the equity markets. They're not seeing that. So for them, especially even after the bell yesterday when I was covering this when this first broke, they just felt like, why now, right? Especially 2 months after we had been talking about what was going on with the debt negotiations. And they're also very careful to make those comparisons with 2011 because it was a very different time coming out of the global financial crisis. You also had this European debt sovereign crisis as well. And then even about a month or two after, you had the Federal Reserve and Operation Twist, which was going on when obviously Fed Chair Ben Bernanke was at the helm. So very different dynamics there, and they're careful. And I mean, the biggest decline that we saw when this had happened, when it was Standard & Poor's that did this in 2011. I mean, you did see a decline of about 7%, one-day decline drop there in the S&P 500, and it had been a big sell-off leading up to how that all transpired. So when you're looking kind of at the broader markets today and seeing that, obviously you can't really compare the two, but we've talked so much about this, Paul, when it comes to seasonality. Yep. August, September, historically, the worst months of the year, especially if you do SEAG go in the terminal. And so some of my sources kind of wondering maybe if it's just another thing on the table as far as a reason to potentially sell and maybe book some profits after we've obviously seen a huge rally this year after last year's bear market.
Jess, on the Upper West Side of the debate here, well, I wanted to tell us what else you're looking at out of the market. Say, any names stand out to you?
Yeah, I mean, it's funny you bring up the Upper West Side, and I was just mentioning this to y'all how I was walking to work this morning, and someone rode by me on a bike, and they were waving at me, and I was wondering who is this? Who is this? No, I thought it was the person on the bike behind me, and I got into work, and one of my new bosses, after 5 minutes of me being here, was like, "So that was me."
And this is why we come into the office.
I was like, oh my God, and he waved to my boss. I didn't know. I thought it was the bike. I thought he was waving to the guy behind me.
Flip him the bird or something.
No, I was just confused. I thought he was talking to the guy on the bike behind me to follow him. So next time I know now. But another thing I'm taking a look at, I mean, obviously we have a number of companies that are moving on those pre-market earnings, but I'm actually taking a look ahead after the bell because this is a big chip week, especially when we're talking about the SOX, the Philadelphia Semiconductor Index. This has been on such a tear after losing more than a third of its value last year. So up about 47%. So after the bell, we have Qualcomm. So that's ticker symbol QCOM that is reporting. So sales are expected to fall for a third consecutive quarter. And this is looking at Bloomberg Intelligence talking about how the consensus calls on Wall Street are for a decline of 22% year over year. So Apple and Samsung, along with some other companies, those are really, when you're talking about Qualcomm's largest customers, accounting for about more than 50% of the revenue. They've also seen some sales weaken, so that's going to be important there. But again, coming into this year, there's been a lot of firms like Barclays pointing that they felt like the worst of the pain has been clearly passed for a lot of these chip makers. And obviously, it's a telltale sign, too, of the economy. So even if they are seeing some struggles there, you think more broadly about some of these chip makers holding up a lot better than expected. So I think that's going to be a big thing to watch after the bell. Obviously, we have Apple and Amazon everyone's looking forward to after the bell on Thursday. But for me, I think Qualcomm's going to be a big name after the closing bell today.
Because we had AMD results this morning, which were pretty solid. And again, when I think of AMD, I think chips for PCs, but they're also trying to, they're also trying to get us onto the AI bandwagon.
It did, and so it said it was making these sort of further inroads when it comes to AI. But that's the thing about, especially when we still have a little bit before we hear from NVIDIA, and it's like, how do you deliver on that? And then also, what are the metrics when you're talking about these different types of chip makers too? So I think that's going to be key too when you are talking about Qualcomm.
Yeah, it's interesting. We had Mandeep Singh on from Bloomberg Intelligence. He covers the tech sector on a couple days ago, or maybe yesterday, and he made a good point, which is you look at the movements in a lot of these tech names, like NVIDIA and some of the other chip names, and they have just ripped. And anything that's gotten the AI kind of blessing has ripped. And boy, that sets up a lot of pressure for earnings.
And I think also not just an AI story, but a lot of these companies, especially even beyond chip makers, also the margin story too and the cost-cutting pressures.
Yep. All right. Great stuff. Thanks so much. Jess Menton, she covers all the equities for Bloomberg News, joining us here in studio. I want to head down to Joe Matthew here. He's Bloomberg's host of Sound On radio and Bloomberg's Balance of Power on television. He's in D.C. He talks to everybody that's down in D.C. He's got his finger on the pulse here. Joe, yesterday was a big day for former President Trump. This is federal. This is Washington, D.C. Is there any kind of growing sense of how this might play out?
It's really difficult to tell. Tomorrow's going to be a big day when he is expected to show up and face the magistrate. But it's interesting, that there's a model for this, because since this is number 3 now, which is remarkable. But there does seem to be a feeling here in the Capitol and on the campaign trail when you talk to people that this one just feels a little bit different. We've talked a lot about indictment fatigue, but when you read through these charges, obstruction of an official proceeding, conspiracy to defraud the government, it's remarkable stuff. I've got the indictment right in front of me here. And it's worth actually reading the document. There's a lot of great reporting on the terminal, and our reporters have been amazing trying to decode everything and kind of unpack everything in here. But the line that jumps out to me, as it did when this first dropped yesterday, each of these conspiracies, I'm reading directly from the text here, targeted a bedrock function of the U.S. federal government, the nation's process of collecting, counting, and certifying the results of the presidential election. That is a remarkable thing to imagine, that a former president of the United States is facing this charge, even as he runs for re-election.
And Joe, I guess one of the big issues that I think we probably all like to get some handle on is timing. Is this something that can go to trial before the election or after the election? There's some differing opinions out there.
Yeah, we just don't know. Look, I'm sure the special counsel would like to see this done before the election, but if there's one hallmark, one strategy that is associated with Donald Trump's legal teams, plural, it's delay, delay, delay. He's going to be approaching all of these indictments the same way, knowing that we likely have another to come from Fulton County, Georgia. So, it's really difficult to tell what's going to happen, as they still are arguing over the trial date for the classified documents case, now this and then another. And also, how do you run a presidential campaign when you're trying to manage all of these legal angles? One thing we do know is his campaign is helping to pay for those legal teams who are awfully busy right now, and he's going to have to hire a lot more lawyers.
Another thing about his campaign, Joe, it's polling very well, very much ahead of the pack here. So, I mean, do you see that? It seems like, every time that a new charge comes about, this really emboldens the Trump base. You see that?
Yeah.
You think that trend's going to continue here?
Probably. I mean, it's hard to see where this ends. If history is any guide, you're right. He's going to gain some polling points, and he's going to make money on this. There are a couple of different ways to look at it, though. There's clearly a short-term benefit for him. I mean, the next in line would be Ron DeSantis, and he's trailing Donald Trump by 20 to 30 points, depending on the poll here. So, look, unless something big happens, unless there really is a concern among the MAGA base about this, and there's no reason for us to believe that, then Donald Trump may well be the nominee. The long-term implications, though, when you put him in a general election matchup against Joe Biden, become a little bit different here, and there are a lot of concerns about how the four potential indictments and other legal action that he's facing is going to fly here in a general election. It's not a good way to pick up independent voters or expand your own base. But I'll point you back to the poll we got this week from the New York Times and Siena College. 20% of those Republicans who support Donald Trump, the real core of the MAGA base, say they would still vote for him for president if he were convicted of federal crimes. So this is just another day.
Why not? Joe, how do you think the other plethora of Republican candidates are going to kind of position these various legal issues for the president in the months ahead? I mean, is this something that they want to make front and center? We can't have this as our candidate, this person as our candidate. Or are they going to try to maybe stay on the sidelines?
It's funny because you've got the people who are running against him, who are afraid to criticize him, even at this incredible moment of what would be apparent weakness. And you've got different shades. It depends on, the Chris Christies and Will Hurds of the world are going to demonize him for this. Tim Scott, though, I was kind of amazed. I have all other statements in front of me here. What we see today are two different tracks of justice, one for political opponents, another for the son of the current president. He's going straight to Hunter Biden on that. Look at Mike Pence, though. This was the most interesting to me, and Mike Pence is not doing very well. He can't even get on the debate stage yet, as far as we know. But look, Mike Pence has a lot to do with this case, and he testified in it. Today's indictment, he writes, serves as an important reminder. Anyone who puts himself over the Constitution should never be president of the United States.
Yep.
Let's see how these evolve over time. If they smell blood in the water, it'll get a lot more severe.
And anything, Joe, that you're expecting from Mr. Joe Biden? He's also stayed pretty quiet on a lot of these headlines.
Yeah, and I think that he'll likely stay that way. They've kept a real distance, or certainly tried to build the appearance of having distance between the Justice Department and then even further distance between the special counsel. So I would not suspect that he's going to weigh in on this. It is remarkable, though, when you consider the day that Donald Trump had yesterday, knowing that Joe Biden was on vacation at the beach and went to see Oppenheimer last night. So it's kind of two different worlds.
Exactly. So one of the interesting aspects of this January 6th indictment is it's in Washington, D.C., Joe.
Yes, right.
That's a different animal than South Florida.
You said.
What's the expectation here about how that will the president be able to get a jury of his peers?
Ron DeSantis doesn't think so, and that's another reaction that we heard from the field. He says Washington is a swamp, and it's unfair to have anyone stand trial before a jury that's reflective of swamp mentality. Oh boy. But look, Washington's pretty good at this kind of stuff, actually, and I suspect that they're going to have this together pretty quickly. The former president won't have much say in that, although his legal team will try to slow this down. In terms of their strategy, we're hearing a lot about the First Amendment today, which is interesting, even though the indictment is clearly about his actions more than the things that he said.
When you say pretty quickly, is that before or after the 2024 election?
Great question. We just don't know. I mean, the special counsel, the Department of Justice, I think will make every effort to get this done before then. We'll hear a trial date soon. Whether that moves again is another question. They've already moved the date on the last indictment over the classified documents. So I suspect that'll be a moving target for a bit.
Joe, Sound On with Joe Matthew coming up at 1 p.m. Wall Street time. I got to think this is still in flux for you guys here as we sit here at 11:15. I mean,
Indeed.
How are you guys going to try to approach this?
Well, we're always building the plane in flight here.
Yep.
But one thing that's consistent on Sound On is our great panel. We're going to have Rick Davis with us today and Matt Bennett, the Democrat from Third Way, to kind of get both sides of this to help sort of flesh out what's going on in this case. And we're going to have some smart legal minds. In fact, I heard just a short time ago that coming up at 2 o'clock, the second hour of Sound On, we're going to be talking to John Dean of Watergate fame and be curious to get his historical perspective on this, too.
And Joe, this is the dumb question of the day. But as we think about the 2024 election on the other side, is the Democratic Party, are they okay with Joe Biden? Or are they, this is our guy, or is it just be too ugly to try to do anything else?
I think this is our guy is the idea right now. He's got a 39% approval rating in that new New York Times poll this week. That's up from 33 a year ago. It's still way underwater.
Yep.
Well, half of the Democrats in that poll say they wish they had somebody else. There's a lot of talk about his age, but let's see where those numbers are when there's a real matchup. Everything right now is hypothetical, and look, Gavin Newsom's not coming to the rescue anytime soon.
Okay. Joe Matthew, host of Bloomberg Sound On radio. You can get that at 1 p.m. Wall Street time. And then Bloomberg's Balance of Power on Bloomberg Television. Lots to talk about there. Always seems to be down in D.C. And now with all these various indictments against the former president and, election next year, I can't imagine being in D.C. Or D.C., if you're anything, I mean, it's just going to be crazy over the next several months.
Sleepy town,
Yes.
Yeah, not much going on.
And it is technically a swamp or built upon a swamp, so I don't know what they were thinking there back in the day. Let's put our nation's capital right here.
It was a compromise.
I know.
New York was considered, but
yep.
They had to, a certain gentleman from Virginia had to be satisfied.
Exactly. So let's do it there. But thank goodness for air conditioning. What did they do before AC down there in the nation's capital? S&P 500 holding on to its declines of 1.3%. The NASDAQ off a solid 2%. Again, I'm going to call out the VIX. It is up 2.25 points. That's a big move in the VIX. That brings it above 16.19. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, Advanced Micro Devices topped second quarter estimates and touted inroads in artificial intelligence computing. But why is the stock down right now? Well, let's go to Bloomberg's Ed Ludlow for some insight.
They said that the market opportunity for their AI offering, which is an AI accelerator GPU or a GPU-CPU hybrid, is $150 billion by 2027. AMD said that in the quarter gone, customer engagement with their AI products grew 7x. But I think there's a sense that engagement does not mean tangible sales. It's still a future opportunity.
Thanks, Ed. Striking Hollywood writers and studios plan to meet this week in the hope of resuming negotiations. Bloomberg's Erica Herskowitz has more.
Steve, the Writers Guild of America says the head of the group representing studios requested a meeting on Friday to discuss resuming contract talks. It's the first official communication between the two sides since writers dropped their pens in protest 3 months ago. Pay raises, staff reductions, and control over artificial intelligence in the screenwriting process are among the sticking points. A breakthrough with the writers will only solve half of Hollywood's problem, as actors are also on strike. Steve?
Thanks, Erica. American Airlines is reportedly in talks with Airbus and rival Boeing to order at least 100 narrow-body jets to replace some of the oldest aircraft in its fleet. Sources tell us the deal size could top 200 aircraft, including commitments for future purchases. Thus, according to sources for us, and Bloomberg Intelligence estimates an order worth around $6 billion. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Treasuries sliding in price. We'll start there in the wake of the stronger than expected U.S. jobs data today, and accelerated their sell-off following the bigger-than-expected plan for increased debt issuance from the U.S. Treasury. So 10-year yields hitting the highest level since November. The higher yields, well, they eat into the technology sector especially. Right now, the 10-year yield is at 4.11%. And it's the tech-heavy NASDAQ 100 that's taking it on the chin right now. It is down 1.99%. Let's just call that 2%. Apple and Amazon.com, one company scheduled to report this week with investors on the lookout for any clues on how high interest rates are affecting the economy. Right now, the S&P 500, 55 points lower. That's down 1.2%. 45.21 on the index. The Dow Jones Industrial Average is down 250 points. That's a decline of 0.7%. And the NASDAQ 100, 305 points lower right now. Again, down just about 2%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Molly and Paul.
John Tucker, thank you so much. We appreciate that. Molly Smith, Paul Sweeney here in our Bloomberg Interactive Broker Studio. Okay, you go get your undergraduate degree from MIT. I'm guessing that's not like English lit. And then you go get a PhD in physics from Boston University. What do you do with all that math?
Rocket science.
You go manage money. Go figure that. George Patterson, that's exactly what he did. George Patterson is the CIO, PGIM Quantitative Solutions, joins us here in our Bloomberg Interactive Broker Studio, making that ride across the river from the Jersey side. George, do guys in quantitative solutions, do they care that rating agencies just downgraded our government? Do you guys care?
We do care. We do look at ratings. I think in this particular case, the U.S. is a little bit unique, and this one maybe is a little bit harder to handicap, given that it's really only happened once before.
Yep. So what do you guys do at PGIM Quantitative Solutions? I mean, you guys over there in Newark manage gajillions of dollars. How about the Quantitative Solutions Group? What do you guys do there?
So we basically do two things. We do quantitative multi-asset, asset allocation, global macro strategies, and we do quantitative equity. And we've been doing that for almost 50 years now. Starting, some of our funds go back more than 25 years in terms of track records.
So you're looking at a U.S. economy right now that a lot of people are saying are going to avert a recession. So what looks good on the investment side then? You would think probably everything.
Well, the U.S. is very interesting. It's a tale of two markets, really. There's an ultra-hot, ultra-cap tech story, which we've talked a lot about, and then there's a lot of cyclicals that have been left behind. So as we see the economy continue to do well, if we do avert a hard recession or hard landing, I think there's a lot of cyclical names, a lot of industrials, a lot of names that have not yet fully participated, that there could be some decent upside in the U.S.
All right, so where specifically, like, what are the top 2 or 3 areas that you guys are kind of putting money to work these days?
So we always run very diversified portfolios. So I can't give you a specific sector, but where we see the opportunity is definitely in some of the more industrial and cyclical names. Technology is one that we're a little bit, we think might be a little bit overextended. A lot of the moves have really been driven by multiple expansion. So, you know, that might pan out, but it also might not.
Do you get, like, in that kind of situation, when you feel something might have gets ahead of itself, do you sell, do you trim, or do you just not add?
So typically we would trim, and I think you have to ask yourself, when something gets ahead of it, what is driving it? In this case, people have a lot of very high expectations about future earnings, particularly for names that are AI related. Those earnings will materialize, but they're not going to materialize in the next quarter or year. This is going to take like 5 to 10 years for AI to really play out.
Yeah, and we were just saying before, what was that pitch you got, Paul, about that?
Yeah, well, the grocery store is going to, you know, I got a pitch from a PR person saying, hey, this grocery store raised its sales 67% because of AI. And I'm like, I'm not even going to click on that. So.
Okay, well, you know, basically the case here to say that if you put AI in front of everything, it's probably going to do pretty well. So is that, I mean, I'm sure from your perspective, it's probably got to be a bit more nuanced than that.
Yeah, look, we think AI is a great technology. It has a very promising future, but like all things, it's going to take time to play out, and there's a lot of work that has to get done before it really gets implemented. So there's some great names that are going to benefit, but there's also a lot of names that are going to take time to really benefit and see the earnings flow through. I think that's really what we need to see, is what is the real business app, what's the killer app that people have to have, that beyond just really the demonstrations we've seen so far.
All right, so Pru, I mean, it's huge. It's the 11th largest investment manager in the world, based in Newark, New Jersey. Outside the U.S., I know you guys are active all over the place. How do you think about investment opportunities non-U.S. here?
Yeah, so the U.S. is, there are pockets of the market, the U.S. market, that are expensive. There are some interesting opportunities, but really outside the U.S. is where we see the biggest opportunity. Europe, not so much, but in emerging markets, it's not something that's going to play out immediately, but if you look at long-term drivers for emerging markets, demographics, where the earnings growth is going to be in the future, people have really left it for dead, and it's a great opportunity.
China? Even with the dollar strength right now?
Yes, you need to be, again, it's not something that's going to play out immediately. It's going to take a little time, but we do think that there's an opportunity.
Now, what do you guys think about China here? In my perspective, uninvestable. But nobody asked for my perspective. They asked you for the perspective. What do you do in China?
So we do see opportunities in China, but it's clients are very bifurcated or very polarized. Some see a great opportunity, particularly in the middle class. Some of them, again, are just a little bit concerned about the political risks and want to avoid it. So we offer a number of solutions where, you know, clients want emerging markets with China or without China. Really, we see a lot of different thinking in that area.
So when you're talking about the EM argument, is this largely in Asia, or like what part of the world are you really excited about right now?
It's primarily Asia, although there's, you know, Mexico is very interesting also. I mean, Mexico is really benefiting from a lot of the nearshoring of business, but we definitely see a lot of interesting opportunities. Korea, Taiwan, you know, even though it's not emerging markets, Japan, I think, could be different this time.
Warren Buffett, that's what Warren Buffett thinks.
It's, you know, I also think there could be some interesting AI opportunities. Don't forget, Japanese companies have a long history of being very successful in technology areas, so I wouldn't discount that.
You know, a lot of folks have come in here really over the last several years, particularly since, you know, China's had some issues with COVID, and then how their government's, you know, overseeing with a much heavier hand business in general, and saying China's the last 20, 25 years. India is the next big China-like growth opportunity. And oh, by the way, supposedly with the rule of law. How do you guys think about greater India?
I think India has a huge potential. It's got demographics. It's got many things on its side. There's definitely a lot of the regulatory environment there. We would think if that were to evolve and it were to become a little bit more efficient, I think there could be a lot of potential there. We have a number of clients for which we provide exposure in India, and I think the same thing. I think it's a great opportunity.
And when you talk demographics in India, I mean, I know we've been reporting on how India is now the most populous country, has overtaken China. But is it also like the age of the population, like the makeup of the workforce? Like what exactly about the demographics that are appealing?
It's really the prime age workers, and where that's going. I think as we've heard about China, there's been a period of time that it was a one child policy, and as a result, that's going to slowly work its way. I like to think of it as kind of a snake digesting something. It takes a little time, but it is going to work its way through the system. Eventually, they are going to have a worker challenge in terms of enough workers to support the economy. India, I mean, the whole world in general looks like it's slowing down, but India definitely has a competitive advantage.
What do you think our Federal Reserve is going to do here? We had that hike. We had most of the central bankers, kind of in unison hike in the last 10 days or so. But now the question becomes, are they done? Do we have another hike out there? Do we see rate cuts next year? Is there a Prue house view here?
We don't have one single house view. We have a number of different experts, and we all debate. Personally, I think there's likely at least one more in the cards. But you know what? I think Powell has been misinterpreted in the past, and I think he's been very clear that he doesn't want to tip his hand, and he doesn't want to say anything that's going to cause people to go out and become speculative.
I got to ask you here, George. Tell us a little bit about your background as a rocket scientist. I see here that you also, I don't know if Paul listed this in your impressive pedigree, but you also have a PhD in physics from BU. Tell us about that.
Listen, physics and mathematics were my passion, and I believe people when they're in college should follow your passion. And I always was interested. I still have a love of it, but I knew that my career path was going to take me somewhere else. There was a little bit of a transition period when I was at the Jet Propulsion Laboratory in Pasadena, California. Nice. There were no more rockets there when I was there. However, there was a lot of space exploration-related technology and developing devices, developing sensors. But ultimately, I joined Barclays Global Investors in San Francisco, which had a very mathematical and econometric view of the world.
Yeah, the math folks tend to do well on Wall Street. I wasn't really a math guy. That's why I went to equities, where I could just tell stories. And if I could say, hey, I think the stock is going to go up because of these three reasons. And you know what? It worked. George Patterson, thanks so much for joining us. George is the CIO of PGIM Quantitative Solutions. That's part of Prudential. Prudential's got a $1.2 trillion investment management business. How about that? You didn't see that coming way back in the day, but there they are. George, thanks so much. Right now, let's head down to Washington, D.C. Amy Morris has got world and national news for us.
All right, thank you, Paul. Getting word at this hour, a jury has reached a decision on whether the man who killed 11 people at a Pittsburgh synagogue should be sentenced to death or life in prison without parole. That decision is to be announced soon. The legal pressure continues to build around former President Trump, even as he remains the frontrunner in the race for the White House. Special counsel Jack Smith says Trump knowingly spread false claims about the 2020 election in a conspiracy to defraud the U.S. and American voters.
Since the attack on our Capitol, the Department of Justice has remained committed to ensuring accountability for those criminally responsible for what happened that day. This case is brought consistent with that commitment.
Special counsel Jack Smith spoke after the indictment was unsealed yesterday in Washington. Terry Haynes is founder of Pangea Policy and tells Bloomberg that the mounting legal trouble for the former president is death by 1,000 paper cuts.
It's another cut, mitigated only because we all had a pretty good idea it was coming. What we've seen in Washington in the past week is a lot of truth stretching all the way around.
Terry Haynes with Pangea Policy says just in the past week there is more uncertainty about who will be the nominees in the 2024 presidential race. The Mega Millions lottery jackpot soars again. Bloomberg's Michael Barr reports.
For the 30th straight time, no one has matched all the numbers. Friday's jackpot is now estimated at $1.25 billion. Some people people are ready to quit their jobs and make money for it. However, this woman is in the why bother camp.
The odds are so against us in what, maybe centuries, decades? No one has won here. No one. So I'm not buying into it.
In New York, Michael Barr, Bloomberg Radio.
And China's capital has recorded its heaviest rainfall in 140 years. Floods have destroyed roads. At least 20 people have died. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 100.
stories, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks are lower. Technology, in particular, under pressure today. Information technology, that is the worst performing major industry sector in the S&P 500. The stocks are selling off as yields climb. The 10-year Treasury yield hitting right now 4.11%. A better than expected ADP payrolls report this morning. The increased Treasury debt sales and the downgrade in the U.S. sovereign from Fitch, all pushing yields higher. On the data front, also on tap this week, going to be the jobs report from the Labor Department. We're going to get that Friday morning. Meantime, Brian Weinstein at Morgan Stanley says uncertainty will keep the Federal Reserve on hold.
This is a point in time where the Fed has raised rates a lot. Listen, let's not forget, on the other side of raising rates a lot, over the next 12 months, there will be impacts, there will be slowdowns. You're seeing it in some of the subprime sectors. You're not seeing it in the broad economy, but it matters. So I think the Fed is taking a pause here because they just don't know.
The S&P 500, 53 points lower right now, 1.2% lower, 45.23 on the index. The Dow Jones Industrial Average is down 229 points. That's a decline of about 0.7%. We're at 35,402. The NASDAQ 100 down 310 points. That's a decline just under 2%. And finally, economists at the Bank of America scrapping their forecast for a recession in the U.S., becoming the first large Wall Street bank to officially reverse its call amid growing optimism about the economic outlook. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Will somebody out there find Molly a home?
Yes.
I feel so...
Please.
Yeah, during the commercial breaks, we're talking about your apartment search.
But an apartment, a one-bedroom apartment, Upper East, $1 million.
That's the going price these days.
I know.
People in the rest of the country hear these conversations. They're like, "Why are these people nuts?"
They're like, why are you buying one bedroom when you come out here and buy a nice 4-bedroom mansion and acres of land?
Yep.
Then you have to
They
live
think
there.
I'm crazy.
They're right. I don't know why we do what we do, but here we are.
We love this island.
Exactly. That's right. All right, John Tucker, thanks so much. Molly Smith, Paul Sweeney here, Bloomberg Interactive Broker Studio. We're YouTubing as well. Just head over to that internet thing and search Bloomberg Global News, and you'll get our feed there. Looking at the markets here broadly, we're selling off today, but the S&P, it's up 17-18% this year. You look to our friends over in the UK and Europe. I've got the FTSE up, a little over 1%. The Stock 600, that's the big European index, that's up about 8 or 9%. So lagging a little bit here. So let's kind of put that all into perspective, because I think they outperformed us last year in a big way. So I know somebody who can kind of bring us up to speed. That Tim Craighead fellow, he's a director of research for Bloomberg Intelligence. He's also the senior European strategist. He is zooming in from our London digs over there, Queen Victoria Street, which is in the center of the city of London, right by the Bank of England and all that stuff. Hey, Tim, so talk to us about the UK, the European markets this year, lagging the U.S., put it maybe in a rolling 2-year context.
Yeah, it's great to be with you guys from over here. It was nice a couple weeks ago when I was visiting you all there. But the context here is on a 2-year basis. We're still, depending on the market you look at in Europe, a little ahead of the U.S. If you were to choose the NASDAQ versus the FTSE 100, it may at this point now be, in the U.S.'s favor. But I think if you were to look at a couple of the key markets in Europe, like the DAX or the CAC, the German or the French market, that weren't as bad as the U.S. last year, and they're up 14-15%. We're doing okay on a rolling 2-year basis. We did, like I said, we didn't have the downdraft last year, and we haven't had the NASDAQ tech-driven fury this year.
Tim, talk to us about the economic picture in the UK as well as the greater Eurozone. It's a little bit different over here in the U.S., where a lot of people are saying U.S. economy is looking great, inflation is slowing down, but over on your side of the pond, it seems like those underlying prices are still pretty hot.
Yeah, and it is interesting. The economic element, if you look at economic growth, is like you all, generally speaking, continuing to be pretty favorable. Unemployment is low. Spending patterns are still coming through. Even in the UK, where it seems like it's a national habit of having angst about lots of things, politics, the economy, whatever. The economic surprise index that you can pull up on Bloomberg is actually quite robust, but inflation is much stickier here. Part of that is a rolling, lagging element of the way that energy prices work through to the end market. And so we're still in the UK paying for energy prices from back earlier in the year. They don't actually roll over into the next contract until October. And so there's a lagging issue where we still have core inflation that's well above what you guys are seeing. There's also more of a wage impact that has played through here with more pretty significant catch-ups on the wage front in terms of various negotiations, strikes like that. So it has been an issue. The Bank of England in particular has been quite adamant on trying to clamp down on the economy to tame inflation. And interest rates here are up significantly, similar to what they are in the U.S.
Hey, Tim, your Bloomberg Intelligence colleague, Gina Martin Adams, here in the U.S. has pointed out to us that the second quarter here will mark the third quarter of earnings decline. So we're in Gina's analysis, we're in earnings recession here in the U.S. How are things over in Europe?
Yeah, it's really interesting, Paul. There's a big difference. If you look at the U.S., we've had this earnings recession driven by a retreat in profit margins. In Europe, we've not set aside the current second quarter reporting period that we're about done. We haven't had this as an issue. Profit margins are still very close to peak levels. We've had better than expected earnings performance over the last several quarters and continue to grow earnings, again, depending on the country you look at, in the mid to upper single digits or even low double digit pace. Now, the second quarter is an interesting one because if you look at the actual top-down figure, it shows minus 10% earnings contraction. But if you take energy out and you take materials, which are mostly metals and mining here, and we know what's happened to those commodity prices, earnings growth for the rest of the European market is running about 7%. More than 50% of the companies are beating, only about 30% are missing. It's been a continuing positive here. We've had better pricing coming through. There's been decent volume mix. And like I said, companies have been able to sustain profit margins better than what's been the case in the U.S.
So, Tim, I know you live in a nice leafy suburb of Boston. At your favorite pub, what's a pint go for these days? Talk to me about the inflation
Belsize
there.
Park.
What's that?
Belsize Park,
Yes.
not Boston. So a pint. If you go to the Washington, which is right around the corner from where I live in Belsize Park, you can spend close to 10 pounds on a pint.
What?
Wow. No. Yeah, it's not quite like spending $1 million on a flat in the upper East Side. But my daughter is looking to buy a flat in Tufnell Park, which is an area not too far from where we are. £500,000 for a one-bedroom flat. But there, the beer, you probably get down to 6 or 7 pounds.
Maybe I should be looking there.
I'm thinking we're telling Molly to maybe broaden horizons from the Upper East Side, but I'm not sure. It's London is kind of what we're thinking about.
I mean, I studied abroad there. I'd go back.
All right. Tim Craighead, thanks so much for the local color there. Tim Craighead, he is the Director of Research and Senior European Strategist at Bloomberg Intelligence, coming to us from London. S&P 500 really kind of rolling over here. We've got it off at 1.25%. NASDAQ off 2% here. So giving up some of the gains that we've seen really just obviously all year, but particularly in the last 4 to 5 weeks, giving some of those gains up. We'll have more more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, shares of Salesforce are down more than 2% as the tech company cuts more jobs. More on that from Bloomberg's Leslie Lotto.
Steve, Salesforce says they're cutting more workers after a previously announced 10% reduction in a renewed focus for more profitability. Sales and customer success employees were let go in Ireland today. A spokesperson says the cuts are separate from a company-wide reduction that was announced back in January. Salesforce plans to cut about 8,000 jobs altogether by the end of fiscal year 2024, the largest for the company ever. Steve?
Thanks, Leslie. Amazon is launching the biggest overhaul of its grocery business since acquiring Whole Foods 6 years ago. Bloomberg's Jeff Bellinger reports.
Steve, the changes include revamping stores, testing new highly automated warehouses, and for the first time offering fresh food delivery to customers who are not Prime subscribers. The company also plans to streamline the shopping experience by merging its various e-commerce supermarket offerings into one online cart. Amazon is hungry for a bigger slice of the U.S. grocery market that is worth an estimated $1.5 trillion, according to analysts at UBS. The tech giant says the changes will roll out in the coming weeks and months. Steve?
Thanks, Jeff. Amazon stock is down now more than 2.5%. And shares of CVS are up after the drugstore chain exceeded expectations in second quarter revenue and profits, but the company warned investors profits will suffer over the next 2 years because of a rise in medical expenses. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Molly Smith and Paul Sweeney here in the Bloomberg Interactive Broker Studio. A little bit of a sell-off in the markets today. I guess that's what happens when a rating agency downgrades your government effectively and the finances of the government. S&P off 1.3%, NASDAQ off about 2.2% here, noticing that, and yields seeing reflected there as well. The 10-year Treasury is up 7 basis points, call it 4.09%. Bitcoin, I'll just throw it out there. Tom Keene's not here, so why not? It's up 100 points, 0.3%, 29,300 on the crypto space right now. Let's head down to Washington, D.C. Amy Morris and Scott, World of National News.
All right, thank you, Paul. We've been telling you all day about the indictment filed against former President Trump. This is the third one since he's left office. This one is tied to the Capitol attack and efforts to overturn the election. Special counsel Jack Smith called the insurrection an unprecedented assault on American democracy.
It's described in the indictment. It was fueled by lies. Lies by the defendant, targeted at obstructing a bedrock function of the U.S. government, the nation's process of collecting, counting, and certifying the results of the presidential election.
Special counsel Jack Smith says Trump is to appear in court on this new indictment at 4 p.m. tomorrow. Members of the Writers Guild of America resuming talks with the motion picture studios this Friday. It'll be the first communication between the two sides since the Hollywood writers' strike began 3 months ago. Now, it's not clear if a similar overture was made to striking Hollywood actors. They've been on the picket line since mid-July. SAG-AFTRA union president Fran Drescher called out the heads of production companies before a New York City Council committee meeting.
Some of them make $78,000 a day and are accusing us of being unrealistic in our asks.
Right.
Talk about tone deaf.
Fran Drescher says the union is prepared to remain on strike for at least another 6 months. A Northrop Grumman Antares rocket blasted off from NASA's Wallops Flight Facility last night.
3, 2, 1.
The rocket carried a Cygnus spacecraft with a payload of supplies for the International Space Station. The mission is to examine fire protection on board spacecraft and the density of Earth's upper atmosphere. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Paul and Molly.
All right, Amy, thank you so much. We appreciate it. In our further discussion of how expensive it is here to live in New York City, it's not just $1 million for an Upper East Side one-bedroom apartment, but now everything, lots of other stuff is going up. I mean, the cost of a subway is going up 15 cents. Residents are set to spend another $15 a month on average for electricity. Everywhere you turn, a slice of pizza, it's up.
Yeah, you know that it broke with the Subway principle. You know
Yes.
that the cheese pizza and the Subway fare are supposed to be the same.
Yep.
Decades of New York economics upended.
Exactly. So, I mean, so it's just, Bloomberg's got some reporting on this about, again, some of these costs that folks who choose to live in Manhattan need to pay. And again, it seems like everything is going up. It starts with the rents, the cost of housing, but then everything else as well. So.
And did you see that the fare increase on the subway accidentally went into effect on Monday? It's not supposed to be till later in the summer, and the MTA then had to refund all these people 15 cents and so forth.
Right. I'll have to check my account there because I used
a big mess.
Zap app account. But I don't know. Here's my thing. I mean, I ride the subway twice a day, every day. To me, it's the most efficient way to get around the city, and I have, huge arguments with people about this all the time. They cite the crime. And I've been riding it since really the early 80s. It hasn't changed. If anything, it's better because we have, air-conditioned cars. Because when I started, they didn't. Not all cars were air-conditioned.
I mean, the platforms would be next, especially, I look at like the men in suits down there in the summer, and I really sympathize.
Yeah, so I don't know. I'm going to I'm going to die on that hill. The New York City subway is the way to go around the city. But we'll see. It's going to cost you more money, but I don't know. They have a big problem with the MTA because not as many people are riding the subway, not even close to pre-pandemic levels during the week. So
they're not buying New York City apartments at the MTA.
No, they're not. I don't think they're too concerned about that. We're going to have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Sonia Meskin, investment strategist and head of U.S. macroeconomic analysis at BNY Mellon. We're going to get her economic call. I'm calling for a soft landing. Let's see what she has to say. Then Brian Egger, senior industry analyst at Bloomberg Intelligence. He covers everything I want to cover. Gaming. He covers the casino business, lodging, cruise lines, all the fun stuff. So we'll get to see what he's seeing there, because we had a lot of earnings coming out from some of the cruise lines, some disappointment too, and has peak travel peaked? We'll just have to see. Plus Steve Kane, he's co-CIO and generalist portfolio manager at TCW Investment Management. Get a sense of what's happening in the fixed income markets. And the folks at TCW are a must call. They manage $1 gajillion, and they know what they're talking about. But first, let's kick this whole thing off with Charlie Pellet.
Thank you very much, Paul Sweeney. Lows of the day right now on the S&P 500 index. Right to the numbers, the S&P down 62, a drop of 1.4%. Dow Industrials down 261 points, a decline of 0.7%. The Nasdaq Composite Index down 337 points. For NASDAQ, a drop right now of 2.4%. The NASDAQ 100 index also lower by 2.4%. 10-year yield at 4.09%. The 2-year, 4.91%. Spot gold down $7.90 the ounce to $19.36. A drop now of 0.4%. West Texas Intermediate crude back below $80 a barrel, $79.37 right now on WTI. It is down by 2.4%. Stocks are falling. Bond yields are rising following a hot labor market reading, and as the Treasury boosted the size of its debt sales just a day after the U.S. was downgraded by Fitch Ratings. The residential housing market is gridlocked, with buyers facing high mortgage rates and sellers not wanting to give up those low mortgage rates. Selma Hepp is chief economist at CoreLogic, and right here on Bloomberg Markets this morning, she talked about the home price backdrop.
The spring of last year, home price growth peaked at over 20%, and it dropped very quickly to 1% rate of growth a couple of months ago. And now at this point, it's pivoting back up, and we're seeing home prices now for 4 straight months accelerating on a monthly basis at a faster pace than they usually do in spring home buying season. So buyers are definitely putting pressure on home prices because there's more of them out there than there are sellers.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Sources tell Bloomberg American Airlines Group is in talks with both Airbus and Boeing to order at least 100 narrow-body jets. World Wrestling Entertainment Executive Chairman Vince McMahon has been served with a federal search warrant and a grand jury subpoena. Shares of WWE are trading lower now, down by 0.2%. And San Francisco-based Salesforce.com has eliminated more workers beyond a previously announced 10% reduction. Salesforce down now by 2.2%, part of a broader-based tech sell-off. Again, recapping, stocks lower, S&P down 64, a drop right now of 1.4%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Molly Smith, Paul Sweeney, here in a Bloomberg Interactive Broker Studio. We're also streaming on YouTube. Just head over to YouTube and search Bloomberg Global News, and that's where you'll find us. The S&P 500, Charlie, was just reporting off 1.4%. When was the last time it declined by more than 1%? I think it might be before Memorial Day. I think our next guest might know a little something about that.
Yeah, just a tad.
Reporting
She's
there.
pretty good.
Yeah, Elena Popina joins us. She covers the equity markets. Elena, we haven't seen a day like this in a while, right?
We haven't seen a day like this since a few days before Memorial Day weekend. So it's been 47 sessions until today. Now, a lot of people have been telling me that they are getting concerned that we haven't had, a big decline or any kind of decline in the S&P 500. We've gone for 5 consecutive months of positive gains in the S&P 500. Now, there are a lot of developments happening today that trigger such a decline. So it's not really surprising to me that we are seeing such a weakness. But yeah, that 47th streak of days without a 1% drop is now over. If we close,
Yep.
yeah, at the current level. So yeah, remains to be seen. We have a few more hours to go.
Yeah, it looks like there's a bit of weakness in the tech space today. What else are you watching out there in the market drivers?
I am watching a lot of tech stocks. They were the biggest gainers during this rally. Amazon and Apple report tomorrow, and they are some of the biggest losers today. Tesla is also down about 3.8%. Anywhere you look in the big tech stocks, there is a lot of concern about valuation becoming excessive and the rally going too far. I'm also looking at American Airlines. It's down 3.7%. Amid that discussion with Airbus and Boeing. Advanced Macro Devices, ticker AMD, has flipped from being one of the biggest gainers on the day to being one of the biggest losers. It reported a really solid earnings quarter. Its AI business is doing okay. Its data center business is doing great. But for some investors, that wasn't enough. Some investors wanted more out of that report and out of the guidance. So lots of weakness today across the board.
So, I don't know. You could make the argument that this is a healthy move in the market. We've had a big rip, particularly all year. It's had a nice performance, but really in the last 4 to 5 weeks, we had Doug Cass from Seabreeze Partners on Bloomberg Surveillance a couple days ago, and he's been investing in these markets for decades. Great track record. He just got really concerned over the last 4 to 5 weeks that the market really had gotten ahead of itself, and he was actually taking money off the table earlier this week and late last week. So maybe it's just a healthy pullback.
Right, and the Fitch development, the Fitch announcement was not necessarily big news for markets because Fitch put U.S. on credit watch negative in May, so we didn't know that that was coming. And the debt to GDP dilemma, the high level of debt, the concern about governance, that is all news to financial markets. So yeah, there is a knee-jerk reaction, but it is understandable considering the rally we've had so far this year.
So we're right now at 12 o'clock. We've got a little under 4 hours till the close here. You think the market could possibly turn it around today?
I don't think, it's a sea of red today. Anywhere I look, every sector is in the red, and tech, the biggest part of the S&P is solidly in the red. So we may see actually, a big down day today. I would say 1.2, 1.5%. That's not unrealistic. Will that be another buy the dip opportunity? Very likely. And I'm looking at earnings season. It was better than expected on many fronts. Yes, we do have a year-over-year contraction in profits, but that is expected. And some of the biggest fears of investors, they didn't materialize. So that is a net positive development.
All right, very good. Elena Popina from the equities team for Bloomberg News gives us a quick update here on these markets, joining us here in our Bloomberg Interactive Broker Studio. We appreciate that. Let's bring on a next guest here because we want to get a sense of kind of what the economic situation. We've got a lot of economic data coming out this week and next week. Sonia Meskin joins us here. She's an investment strategist, head of U.S. macroeconomic analysis at BNY Mellon. Sonia, thanks so much for joining us here. I don't know. Let's start with Fitch. It's not every day that your government and the finances of your government get downgraded. As an economist, how do you feel about this?
It's understandable. Fitch had told us in advance they would be doing this, and it is reminiscent of what the S&P did in 2011. And even in terms of the timing, it's not that different. Now, of course, it's less of an event that I believe the S&P downgrade was in 2011, and the main reason being that investment mandates have since then been adjusted to allow for not only AAA rated securities, for majority at least, type of mandates, but for U.S. government rating or the equivalent. And so I think this will be have less of an impact on the market than the 2011 development did. But that said, it's important to keep in mind why Fitch is doing this, and all the reasons that they cited in their downgrade are very valid and certainly a longer-term concern for investors.
And we're looking at right now, Sonia, an economy that's doing pretty well here, that a Fed that might still hike rates, one more time, maybe even more than that in this cycle. Does this play into the Fed's calculus at all, you think?
I think that in the near term, not so much, because you haven't seen a strong impact in the markets, I would say. I think maybe the refunding announcement, the larger, auction sizes, that is probably more impactful for the Treasury's near term. But for the Fed, the biggest concern is, inflation outlook, price stability, and employment. So they're going to be paying more attention to those indicators, I would say.
Sonia, we're going to get some important jobs data from the government on Friday, but we got an ADP print today. ADP employment change came in well above expectations yet again. What are your thoughts on this labor market? For a lot of folks, it's showing surprising resiliency.
Yes, and I agree. And I think a lot of this has to do with the structural shortfall of supply relative to demand, which may have been exacerbated with the COVID dynamics. It also has to do with a very strong consumer. So, for example, you can see that the consumer is really resilient through and has been through the last couple of years. ADP numbers are very, very strong. I wouldn't expect the one-to-one core pass-through to, the non-farm payrolls this Friday. But it is indicative of the trend. You're right.
And, we're getting a lot of more people saying here now, Sonia, that the soft landing argument is looking a lot better these days. Where are you in that camp? Or do you think there's even a risk here that potentially people are maybe declaring victory a little too soon and that the economy could even reaccelerate?
I do think there's a risk of that is underappreciated by the markets today. I think that the probability of a soft landing may have risen since the last few months, but it's not 100%. And I think that those tales of either reacceleration or a more pronounced slowdown are underappreciated by the market today.
You talked about the timing of the Fitch downgrade. We also heard from the Treasury about some auctions coming up to fund our government. And interest rates are so much higher, and the deficit continues to climb. When does that become a problem for, I guess politicians? We know economists have been calling out this risk here of the budget, of the growing debt and the budget deficits every year. But now interest rates are a lot higher, so it's a lot more expensive to fund that.
Sure, it's more expensive for the government to fund itself, and it's going to be increasingly more expensive for the private sector to fund itself, both because more corporates are going to have to refinance into a high-rate environment, and because there may be some crowding out effect from larger government issuance as well.
So, Sonia, I wanted to come back to this idea of inflation and the economy potentially reaccelerating, and what that means, for the Fed, if they're going to have to get more aggressive again. And how that fits in with all these people now dropping their recession calls. Do you think maybe more delaying the call is the right move?
Yes, I would agree with that. The economy always goes through fluctuations. A recession at some point in time is almost inevitable. But the timing may have been pushed out relative to, earlier this year. But I do think we're certainly seeing the seeds of a slowdown, potentially just a delayed landing.
So, Sonia, I'm probably in the camp, and so many people ask me my economic forecast, so I feel like I have to give it. But, a couple of weeks ago, I said I'm taking recession off the table. But I recognize that it's still out there. But inflation, I'm just looking at some of the inflation measures. They are trending in the right direction. But one that's not is just kind of oil and energy and gasoline and things like that. And I know that's something that the Biden administration pays attention to, because people feel that immediately in their pocketbooks. Are you concerned that inflation may have another leg up, perhaps?
I'm concerned that it would stay sticky, especially core PCE versus CPI in the next, towards the end of the year, I would say. And that is because rents, which are sort of rent metrics, feed through to the CPI measure with a delay, and rent prices started to decelerate last year, and we're seeing the effect this year. And I think that is a bigger component of the CPI measure than the PCE measure, which the Fed pays traditionally more attention to the latter. And I do think energy prices are structurally important, because even though the Fed pays attention to core inflation, if energy prices stay elevated over time, that is an input cost that is going to affect the prices of goods and services.
Sonia, thanks so much for joining us. Always appreciate getting your perspective. Sonia Meskin, investment strategist, head of U.S. macroeconomic analysis at BNY Mellon, Bank of New York. Address?
Of BNY?
Yes, Bank of New York.
It's down in the financial
Number one
district.
Wall Street, the best address on Wall Street.
Look at
in the
that.
financial services. It's good stuff. All right, now you're telling me, Molly, that there is an internal Bloomberg chat for tennis geeks?
I don't know why you're surprised about this, Paul. There's
I didn't know
IB
there was
chats
such a
for
thing.
everything
Is
in
there?
this firm.
Okay, I didn't
oh
know
my
that. All right.
goodness. There's a dog chat if you want to be in. I'm not a pet person, but
Okay, but all right, so
there's-
in this
oh,
tennis
yeah.
chat, there are like-minded people, let's put it that way, right?
Yes.
All right, what's happening in the world of tennis I need to know about? Because I'm just geared up for the U.S. Open. I've got my ticket for the first Tuesday of the Open. I'm all fired
I
up.
will
It's one
see
of my
you
favorite
there.
events. Okay.
All right.
But what else is, like, I'll focus on the U.S. Open big time, Wimbledon big time, a little bit on the French, not so much Australia because it's at the other, time zones and everything. But what's
That's pretty
happening right now?
soft excuse.
It is,
Come
I
on.
know, it
You're not
is.
waking up at 3 a.m. to
No.
watch these guys go at it.
No. So what are you watching in the world of tennis these days?
Well, some intel in the tennis chat today that somebody posted that Federer, well, that's Roger Federer, of course, was at Uniqlo in Manhattan today. He was doing an interview with the GQ director about an hour ago.
Oh, okay.
It seems like that was a missed opportunity. I don't know where our producers are, maybe asleep at the wheel here.
Yes,
that
they
we
could have gotten
should have had
Roger.
him on the show.
Exactly. So, all right. So, what are we thinking about the U.S. Open here? It starts at the end of this month, end of August. We're already in August. I mean, what are the big storylines?
I think one of the big ones for me on the women's side is seeing Caroline Wozniacki come back.
She's coming back?
That's right.
Wow.
Yeah, she had a baby. What was it? A year or two ago.
Good for her.
And is now there, but with several other moms coming back
Okay.
to play tennis.
for them.
Svitolina still making a really good stretch. She's doing well down in D.C. right now, the Swamp, as we referred to it earlier in the show. So I think that's a really exciting one.
And the men's side, it's Djokovic and the new
Alcaraz.
Alcaraz, right?
Yeah, they've really set themselves apart from the rest of the field here. I think you maybe get some other people who, hard courts tend to be a bit more of an equalizer, where you get some people who are very uncomfortable on grass or very on clay. So I think hard courts there tend to be more people who can play better on that surface.
Yep. I mean, here's my pitch for the U.S. Open tennis. Not that they care what I think, but I think it's just one of those. It's got top 10 things to do in New York City in your lifetime. You should go to the U.S. Open tennis out there. It is an awesome experience, and I like going early so I can see lots of people practicing and all that kind of stuff. But I go in the daytime because that's fun to roam around. The nighttime matches are just epic too.
It's really just the best ticket in sports, 100%.
Yep.
Can't hype it enough.
It's good. It's good stuff. So if you have a chance, get to New York City, get to the U.S. Open out in Flushing. It's good stuff. We're going to have more coming up. This is Bloomberg. Let's get some company news with Steve Rappaport.
Its first ever profit, a ride-hailing service is getting in on the chatbot trend. Bloomberg's Gina Cervetti reports.
Add Uber to the long list of companies turning to artificial intelligence chatbots to help with things like customer service, marketing, and other automation. The CEO told Bloomberg that Uber is working on an AI-powered chatbot right now. Though no details were mentioned, DoorDash and Instacart are also building chatbots.
Thanks, Gina. Shares of Uber right now down more than 1.5%. Sticking with trends, the new fad of using diabetes drugs to lose weight has some resistance from the ones footing the bill. Bloomberg's Joan Doniger reports.
There is a limit to the weight loss people are seeing from those diabetes and other drugs shown to help you take off pounds. That limit is what your boss will pay. The Wall Street Journal reports so many have turned to drugs such as Ozempic to lose weight that some employers are cutting off insurance coverage because their bills are skyrocketing. Spending on the drugs can top $1,300 a month per patient. For insurance plans, that comes to tens of millions of dollars.
Joan, the anti-obesity drug market is so hot right now. Morgan Stanley analysts raised their estimate to $77 billion worldwide in 2030. And the nation's largest retailer still reigns supreme. Walmart tops Fortune's Global 500 list for the 10th year in a row. American businesses took 5 of the top 10 spots on that list. Joining Walmart in that elite group, Amazon, ExxonMobil, Apple, and United Health Group. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Back with more Bloomberg Markets with Paul Sweeney coming up right after this.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg with the Dow, the S&P, NASDAQ, all in the red. Slight bounce off the bottom. Emphasis on slight for the S&P 500 index, down 59 points right now, a drop of 1.3%. We've got the Dow down 222 points, a decline of 0.6%. The NASDAQ Composite Index down 342, a drop there of 2.4%. NASDAQ 100 Index now lower by 370 points. That index dropping by 2.4%. 10-year yield 4.08% with the 2-year at 4.90%. Spot gold down $8 the ounce to $19.35. West Texas Intermediate crude trading back below $80 a barrel, down now by 2.6%. Lots of earnings. CVS Health is warning investors that profit over the next 2 years will be hurt as medical expenses rise in its insurance unit. CVS shares, though, are up now by 4.3%. Also reporting earnings this morning, we heard from Humana. That stock up by 6.4%. And Yum Brands out of Louisville, Kentucky, up now by 0.6%. Yum, of course, the parent of KFC, Taco Bell, and Pizza Hut. I'm Charlie Pellet. That is a Bloomberg Business Flash.
You know, back in college in Virginia, where there wasn't any pizza, I was a huge Pizza Hut guy.
Really?
Yeah, because, I mean, you're in Richmond, Virginia. It's, you know, there's no pizza there. So you had to rely on the Hut. Charlie Pellet, thanks so much for joining us. And I kind of got into the Hut. It wasn't so bad. We had some good times there. All right, Brian Egger joins us here, senior gaming and lodging analyst for Bloomberg Intelligence. He has the career I wanted, but I had media, which is pretty good. So I got to go to a lot of movie premieres and theme parks and stuff. But this guy goes to casinos, cruise ships, hotels. I mean, it's a scam, and he gets paid for it.
Unbelievable.
He's built a career out of this thing. All right, Brian, let's start with the theme, the cruise business. Norwegian, the stock got just crushed. Was it yesterday? They had some results. I thought people were still going crazy on the cruise ships. What's going on?
Yeah, I mean, they really are. I mean, I think if anything, the worries are a bit more on the cost side. You know, bookings are strong. People are booking longer cruises, longer in advance. Basically, 2/3 of the inventory for this year is already sold. So most of the bookings taking place now are for 24, 25. I think maybe there's a little caution on fuel and operating expenses going forward. There's going to be, because most of the cruises are like sold out for this year, there may be more dependence on what happens with onboard spending. If anything, they were too good with revenue management, booking cruises up front. So I think overall, there's just maybe a hope they might raise guidance, but you know, in terms of demand, it's there.
So, I mean, here's some of your research. More than 70% of bookings in the last 90 days for Norwegian are for 2024 and 2025 departures, pointing to a longer bookings lead time and 4Q fare gains of 10% versus 2019. Man, that's healthy. It seems like, right?
Yeah, I mean, we're certainly back at a strong point, and they've booked most of this year, right? So.
And what kind of, I mean, how much do you, when you're booking that far out, surely you've got to put down some kind of a deposit first, like but are people really even paying for these all the way up front, or how does that look from a cash flow situation?
I mean, you can track advanced deposits in advance, and those have been really strong and healthy. I mean, the demand is there with people booking both the longer cruises and longer in advance. You know, occupancy may peak out a little below the last peak because they're booking these longer immersive itineraries, but you know, the demand is demonstrable.
Boy, I'm just looking at the FA function on the Bloomberg terminal for just Norwegian Cruise Lines, and you kind of forget a little bit how hard hit they were in the pandemic. And I know we talked to you a lot during the beginning of the pandemic because, you know, cruise ships are like the last place you want to be during the pandemic. But, you know, in 2019, $1.9 billion of EBITDA, nice, healthy company, right? 2020, they lost $1.1 billion of cash flow. 2021, they lost $1.8 billion and started to come back. Last year, a loss of $680. This year, they're going to make EBITDA, you know, they're going to have $1.9 billion, and then next year, $2.3 billion is consensus. So, boy, there's an industry that really got hit. Talk to us about the balance sheets of this company, because one of the things I remember from the pandemic, one of the first weeks or 2 weeks of the pandemic, these guys hit the bond market, the industry.
I mean, the balance sheets are much stronger. I'll let my credit counterpart, Jody Lurie, speak to the specifics, but, you know, they definitely are back in much better shape. They certainly did tap the equity markets during the downturn when they were not cruising at all. but they're back to a much healthier position. And all those positive yield comparisons are versus 2019. So we're kind of above water where we were back pre-pandemic.
And I remember I was actually covering credit before I had switched over to the economy team during the pandemic, talked to Jody, among others. And, it was amazing because we saw companies like Carnival, like Norwegian come to the bond market and had to always do secured issuance. There was no way you were getting a deal done without collateral. And I think Norwegian even put up an island at the time to secure as collateral. And I see Carnival now is doing secured debt issuance. Is that still really necessary that they can't go unsecured at this point?
So again, I'll defer to Jody on a lot of that, but they've got attractive forms of financing. Generally, they have access to export credit financing. They generally are in a good free cash flow position now that they're back in cruising, and so we've gotten past that point where they were negative EBITDA. We're now on a much better course.
All right, let's talk my favorite business, casinos, baby. MGM Resorts, which, by the way, I remember that when MGM Resorts opened up in Atlantic City back in the 70s, was it? 80? I don't know, way back in the day. Anyway, that stock is up 48 or 46% year to date. Did they sell the Mirage?
Yeah, so they sold the Mirage. They bought the Cosmopolitan, which is kind of next door.
The Mirage, when I started really going to Vegas for business back in the early 90s, the Mirage was the bomb. That was the place to go. Yeah. They sold it?
Built in '89, it's now not the newest kid on the block anymore. But they also sold Treasure Island at one point. But they bought the Cosmopolitan, so really they're kind of integrating.
That's a good trade, right?
Yeah, I think they're assembling a more maybe slightly younger
is
set
the
of buildings.
Cosmopolitan part of the new place?
Yeah, it's adjacent to City Center, and it almost feels like it's part of that complex anyway. So that made a lot of sense as a transaction.
All right, I haven't been to Vegas in a while. I don't know how the Strip is surviving without me, but how are things in Vegas? Is it the business of Vegas? How is it these days?
Yeah, if you look at like the second quarter, which we just got some numbers for recently, those gaming revenues are up overall 28% versus the comparable period of 2019. Wow. So we're flat year over year, but last year was a big year of recovery. So Vegas is really back in a significant way. Convention bookings are strong. So we're a long way off the bottom.
It's so interesting. We're looking into this on the economy side that apparently Las Vegas has one of the highest unemployment rates of any metro area in the U.S. right now, 6%. National average is like 3.5, 3.6 right now. We'll see on Friday what the latest look at that is. Do you have any insight into that?
I think generally speaking, in particular the Vegas local markets where Boyd and Red Rock operate, they benefit from a lot of the resort adjacent economy, whether it's resorts themselves or construction activity. So a lot of things I think will be constructive for that economy going forward, whether it's new resort construction, although that's at a slower pace, or the building of the A's moving to Vegas, at the former Tropicana site. I think all those things like the Allegiant Stadium, where the Raiders play, the A's moving there, sports, new construction will help.
What's sports betting done to? I mean, I can pull up an app anytime and lay down a bet. How has that impacted kind of the casino companies, the gaming companies that you follow?
I mean, historically, the brick and mortar part of the business, historically, sports betting is only 2% of that business. It's principally dominated by casinos. Yep. The online business, although Nevada is certainly not the biggest state in that regard, it's been. I don't think it's really taken share away from brick and mortar gaming per se, although the vast majority of sports betting revenue that's generated in states with both brick and mortar and online is coming from online.
Right.
Can you give us over here, Brian, just a quick outlook on the hotel space? No, that's also in your purview.
Yeah, so we had Marriott earlier this week. We'll have Hyatt tomorrow. I mean, what we're really kind of seeing here is domestic leisure travel still strong, but China's coming back in a big way. If anything, international revenue per available room is now growing more quickly than the U.S. And even within the U.S., we're seeing some shift away from domestic leisure travel, which has been monstrously strong, to a little bit of a tilt towards people traveling overseas to Europe and Asia. And within China, in-country travel is back. So we're kind of seeing the leadership, maybe perhaps in pricing and revenue, shift to a little more towards the upscale luxury side and more towards non-U.S. and China. U.S. still strong, but I think with the travel restrictions being relieved in China, that's coming back too.
And one of the areas you see that, I know is also in your purview, which is the Macau, and that is the gaming driver globally. What's going on in Macau?
So Macau, you look at like the second quarter also, it's down still pretty sharply versus pre-pandemic, like 38% decline in the second quarter. That's largely because the travel restrictions in Macau, China eased more slowly than North America, and the VIP junket credit business was pretty much banned, if you will. So now we're relying more on the mass business. It is coming back. Mass is down a lot less than before, and the business there is getting stronger. It's just going to take longer because the travel restrictions were in place for a longer
And what's the
period of
play
time.
there? If I want to get a play on Macau, is it Las Vegas Sands?
So there's the companies that are traded in and purely exposed there, and then within the North American companies that I cover, among degrees of exposure, Sands has got like the most properties and most exposure, along with Wynn. MGM is a slightly smaller percentage of his cash flow, but all the big three, MGM, Sands, and Wynn, have exposure there.
Looking at the stocks for those, I mean, they're all, for trailing 12 months, they're all up kind of 50-60%. Las Vegas, Sands, Wynn. So interesting stuff. All right, Brian Egger, thank you so much. We can talk about anything with this guy. I mean, hotels, cruise, the whole 9 yards. He's got it covered. All the fun stuff Brian Egger covers, and he's not really a gambler either.
No,
so it's
really?
like no fun.
With going through all those
when I go to Vegas, they know I'm coming. All right, right now, let's head down to Washington, D.C. Nancy Lyons has got world and national news.
Thanks, Paul. A Pittsburgh jury is recommending the Tree of Life synagogue gunman be sentenced to death for the nation's deadliest attack on Jews. Robert Bowers killed 11 people after storming into the synagogue in 2018. Washington, D.C. is preparing for tomorrow's arraignment of former President Trump on 4 counts connected to his alleged efforts to overturn the 2020 presidential election. It's still unclear if Trump will physically attend his arraignment or appear virtually. Bloomberg Law host June Grasso says these are serious charges.
It is the big one of the cases that he faces so far, because it goes to the very heart of democracy, and it's very well put forth. It's laid out so well, and it anticipates a lot of the defenses that Trump might have and knocks them down. And the level of detail in this is really incredible.
Bloomberg Law host June Grasso. John Lauro is representing the former president. He spoke with Savannah Guthrie on NBC's Today Show about whether they will have a speedy trial.
We're entitled to understand what the charges are. We're entitled to do our own investigation. The special counsel or the Justice Department, the Biden Justice Department, has had 3 years to investigate this. To take President Trump to trial in 90 days, of course, is absurd.
Lauro says he's absolutely sure they will win the case. Canadian Prime Minister Justin Trudeau is separating from his wife Sophie after 18 years of marriage. She made the announcement today on social media. She's a former TV reporter in her home province of Quebec and has been on the campaign trail with Trudeau through 3 elections. She posted on Instagram, quote, Justin and I would like to share the fact after many meaningful and difficult conversations, we've made the decision to separate. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long at Bloomberg. The Dow, the S&P, NASDAQ, all in the red off. Session lows right to the numbers. We've got a 320-point drop right now for the NASDAQ Composite Index. Tech stocks leading the way lower. NASDAQ now down 2.2%. S&P down 56, drop there of 1.2%. Dow Industrials down 241 points, a decline of 0.6%. Broad-based selling today with the Russell 2000 down now by 1.5%. 10-year yield 4.08% with a 2-year that's yielding 4.89%. Spot gold down $7 the ounce to $19.36, a drop there of 0.4%. And West Texas Intermediate crude is down 2.5%, $79.37 for a barrel of WTI. Lots of cross currents today. Chuck Lieberman is Chief Investment Officer at Advisors Capital Management. And on surveillance this morning, he was asked for his reaction to the Fitch downgrade.
It's hard to imagine that anyone is unaware of the budget deficit. It's large, way too large. Everyone knows that. And so this is hardly a surprise or hardly inconsistent with what we know about the budget. But I don't think it's going to put a lot of pressure on the U.S. government to reform its ways.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. After the bell today, it'll be Qualcomm and PayPal, among many others. Today, we have shares of Qualcomm down 1.2%, PayPal down 3.4%. And, of course, tomorrow, Apple and Amazon. Apple down now by 1.7%, Amazon down 3.1%. Coming up at 1 o'clock Wall Street time, an interview with Richard Francis, co-head of America's Sovereigns at Fitch Ratings. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Molly Smith, Paul Sweeney here in the Bloomberg Interactive Brokers Studio, and we're also streaming. That's what the kids do these days. So we're over on YouTube, and you can check it out. Search Bloomberg Global News, and you'll find our stream there. All right, it's not every day, a rating agency downgrades my government's credit rating. I mean, that doesn't seem very patriotic, but I don't know if the market cares or should care. So I'm going to check with an expert, Steve Kane, co-CIO and generalist portfolio manager at TCW Investment Management, a little firm out there in L.A., South Figueroa Street, if my memory serves, from back in the day. Hey, Steve, do you guys at TCW sit around in your, all you fixed income geeks sit around, do you really care that much about what happened today with our friends at Fitch?
Not really, and the market doesn't seem to care either. I think it's a little embarrassing. No government wants to see a rating agency say they don't think you're as creditworthy. But there's really no new news in the downgrade. The factors and the rationale they use, the erosion of governments and the debt ceiling issue and the increase in the deficit and the rising debt to GDP. These are all things that market participants knew, so there's really not any new news. What could have been an issue is some technical selling if investors are sensitive to the rating on Treasury debt, but that's really not the case. Investors and the indexes don't look to the actual rating, so it really has had, in effect, no impact to us or to the markets, it appears.
Well, Steve, that's what I wanted to actually follow up with you about on this idea that there, any possible forced selling. And for any of you guys listening, there are some investors that maybe can only hold certain ratings of debt. So that's why this might have been an issue. But there really isn't a whole lot of AAA debt out there to begin with. So I can't imagine there are a ton of funds that only allow themselves to hold AAA debt.
Yeah, there isn't. And the other thing that happened back in 2011 when we went through this the first time with S&P is people began to ask the question, well, what happens if we get another downgrade? And a lot of investors changed their policy to just allow the holding of U.S. Treasury debt regardless of rating. So I think that this, while the timing isn't anticipated, I think people were prepared for this, and we haven't heard of any forced selling.
All right, so if you're not focusing, you and your colleagues, not obsessing over the Fitch downgrade, what are you guys thinking about? What are some of the 2 or 3 things that you guys are are working on as you think about your portfolio?
Well, we're taking the long view, and it's the long view is getting longer based upon our view that eventually the 5+% of tightening and the big rise in interest rates and the tightening of financial conditions is going to slow the economy and create a recession. So we're looking for signs of that to occur, and you can see some signs. The inverted yield curve, the tightening of credit standards, and senior loan officer survey. There's indications in the labor market with the JOLT survey, but the dominance of coincident information in terms of what's going on in the labor market, consumer spending, and corporate earnings is suggesting the economy is not about to roll over anytime soon. So we're looking for forward-looking signs, in the labor market and the credit markets, and we are seeing them, but it's just playing out in a very, very slow fashion.
Yeah, I mean, I think a lot of people would tell you that the data that you're referencing here is, really supporting that soft landing call. And we saw B of A today reverse their recession argument, that they're seeing now the soft landing is the most likely outcome. What do you think it would take for you and your colleagues to get a bit more optimistic on the U.S. outlook?
I think it would be for the market to get more pessimistic, meaning I think
Really?
we take comfort. Well, I think we'd take comfort, actually, a little bit in a contrarian sense to the fact that everybody's getting warmed up and really comfortable with the Goldilocks soft landing scenario. The last time we were sort of hearing a lot of this no landing talk was early March, and what happened, and the yield curve was 100 basis points inverted. What happened? We had a banking crisis. There were plenty of soft landing calls back in 2006, 2007, even early 2008, before the worst financial crisis and recession, up until the pandemic. So I don't think that our long-term view is in any way, deterred, if you will, by the consensus moving in the other direction. We understand why. And I think what it just means is the Fed's going to have to stay hawkish, keep their foot on the brake, and probably increases the likelihood, somewhat paradoxically, that we have a harder landing, because the Fed's going to have to over-tighten, and the Fed focuses on lagging indicators, labor market, inflation, which lag the cycle. So it probably means the Fed, it almost guarantees, I think, the Fed stays too tight for too long. So it just, from our standpoint, instead of it being a 2003 call, it moves into 2023, rather. It moves into 24, probably middle of 2024.
Hey, Steve, I'm just looking at the Bloomberg U.S. Corporate High Yield Total Return Index, up 6.5% year to date. That's a heck of an improvement off of last year. Do I still have room to go with my high yield portfolio?
Well, I think you're still carrying it, 7+%. It sort of depends. We think you'll do okay with high yield. You're starting with enough yield cushion where you can withstand some rate rise, a little bit of spread widening. We don't think you're being compensated well in high yield relative to other high quality parts of the market, even treasuries or investment grade corporate bonds, because we expect that spread on high yield to widen as we get into a recession. But I do think high yield is not a horrible place to be and collect a 7% coupon. It means you can withstand some price volatility and still, eke out a positive return.
How about the rest of the credit universe? Anything interesting there?
Yeah, you probably heard us talk over and over again. We'll continue to, talk our position on agency mortgages. It continues to kind of underperform high yield and corporate bonds, but spreads are really wide, over 170 basis points to Treasury. That's almost 70 basis points more than investment grade corporate bonds with no credit risk. It's also liquid and has no credit risk, which we think is really attractive going into a recession. There's a lot of reasons they've underperformed, including the Fed is not buying and whatnot, but we think it's an extremely attractive part of the market.
All right, Steve, thanks so much for giving us some of your time. We always appreciate it. Steve Kane, he is the co-CIO and the generalist portfolio manager at TCW Investment Management, one of the smartest group of folks out there, I can tell you, based upon my experience with them over the years. Some good stuff. We're going to have more coming up. This is Bloomberg. Let's get get some company news right now. Steve Rappaport.
Paul, despite topping quarterly estimates and touting inroads in AI computing, shares of advanced micro devices are down more than 6%. Bloomberg's Ed Ludlow reports.
They said that the market opportunity for their AI offering, which is an AI accelerator GPU or a GPU-CPU hybrid, is $150 billion by 2027. AMD said that in the quarter gone, customer engagement with their AI products grew 7x. But I think there's a sense that engagement does not mean tangible sales. It's still a future opportunity.
Thanks, Ed. CVS stock has been up most of today's session following better than expected revenue and profits in the second quarter. More from Bloomberg's Abigail Doolittle.
They beat on the surface level. Prescriptions filled was a positive. The revenue grew 7.6% to nearly $29 billion. The insurance medical benefit ratio grew to 86.2%. The bad news, though, next year and the year after, for 2024, they're saying they can no longer meet their guidance of $9 per share, earnings per share. And for 2025, they can no longer meet $10 of earnings per share. So that is weighing on the stock.
Thanks, Abigail. WWE Chairman Vince McMahon was served last month with a search warrant and a grand jury subpoena related to allegations that he paid millions of dollars to settle claims of sexual misconduct. WWE disclosed those developments in a regulatory filing today. The company also revealed McMahon is on medical leave following spinal surgery. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. More of Bloomberg Markets coming up, followed by Sound On. That's next on Bloomberg Radio.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right. Molly Smith, Paul Sweeney here in the Bloomberg Interactive Broker Studio, looking at these markets here. S&P 500 off 1.3%, continuing that weakness we saw all throughout the morning. They've seen it really on the NASDAQ. NASDAQ off about 2.2%, so we'll keep an eye on that. Yields pushing higher. 10-year Treasury up 6 basis points, 4.08% on your 10-year. And I'm keeping an eye on oil because that's what I like to do. We're off 2.5% here on WTI crude oil, $79.33. So that's what's happening out there. Lots of news for this market to digest. We'll stay on top of it. Right now, we're going to head it down to Washington, D.C. We're going to get world and national news, and we're going to do that with Nancy Lyons.
Thanks, Paul. The latest indictment of former President Trump charges him with conspiracy to reverse his election loss through deceit and false claims of voter fraud. It also lists the actions that Trump allegedly took to overturn the results. Trump will be arraigned tomorrow in Washington. One big question is if this latest indictment will influence voters. Brown political science professor Wendy Schiller says it likely will not sway Trump's core supporters.
Will they budge? I don't think so. But the bubble of independent voters who have defected really from the Trump, message in the last 3 elections, they're not going to be happy with all of this, right? This just suggests more chaos, more difficulty, Trump fatigue.
Brown's Wendy Schiller says Trump's GOP rivals need to show they are fighters, too, if they want to siphon off any of Trump's voters. It'll be the death penalty for Robert Bowers, the man who killed 11 worshipers in the deadliest anti-Semitic attack in U.S. history. A Pittsburgh jury announced the verdict just a short time ago. Highway safety regulators are looking into steering issues with Tesla vehicles. Bloomberg's Amy Morris has more from Washington.
NHTSA's Office of Defect Investigation says it opened a preliminary evaluation into Tesla's Model 3 sedans and Model Y SUVs. That's about 280,000 vehicles. The agency says it received 12 complaints about the steering issue. No injuries or deaths have been reported. This is the latest investigation launched by federal regulators who have also looked into Tesla's seat belts, steering wheels, and driver assistance features. In Washington, I'm Amy Morris, Bloomberg Radio.
More changes are coming to Elon Musk's latest social media venture. TweetDeck has a new name. It's now called X Pro as part of the total rebranding of Twitter to X. The company's X handle is @Pro instead of @TweetDeck, but many parts of the tool still reference Twitter and TweetDeck. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Molly.
All right, Nancy, thank you so much. We appreciate it. Well, the news of the morning from the economic front is Fitch downgrading the U.S. Credit rating. Let's bring in Stuart Paul, U.S. economist with Bloomberg Economics. I've been saying all morning, Stuart, it's not very nice. It's not very patriotic. What does it really mean, and what would you take away from it?
You're right. It's not very patriotic, but it is a recognition of the fiscal trajectory that the U.S. has been on. And like it or not, we've been on an unsustainable fiscal path for quite a while now. And the mounting debt burden and the increased interest expense that we're going to be paying on that debt burden, really reaching about 5% of nominal GDP by 2028, is the sort of thing that ratings agencies have to recognize.
Can you put that 5% number in context with, I don't know, Germany or Canada or whatever? I mean, is that high? It seems like it
is high.
But I don't know how high is that.
It is high, and it's funny. Fitch even referenced the U.S. group of peers, domestic market group, sovereign peers.
Okay.
It's really difficult to look specifically at peers because Germany doesn't issue sufficient volume of bonds or rely on deficit finance like the U.S. does.
How do they finance?
They have a lot of exports, right? A totally different economy, right? So it's difficult to compare a country like the U.S. to any sort of set of peers like that. So it's the sort of thing that we have to keep in mind when we're trying to search for reasonable comps.
Yeah, so Stu, I know a lot of your research is more on the monetary policy side of things rather than fiscal, but so when you're looking at the Fed and maybe another rate hike coming later this year, do you think the Fed, even in the coming speeches we'll hear from, that any policymakers would comment on this downgrade and what they might have to say?
There's definitely going to be a recognition of the fact that it introduces some degree of instability. We see risk assets trading off. The consequences for rates is a little bit less clear. right? The initial reaction was to see rates starting to fade as there was a move from risk assets into safer assets. That would actually open the door for the Fed to hike, say, in November, perhaps. But again, it's the sort of thing that the Fed's not really considering directly in its monetary policy decisions. It's focusing primarily on its dual mandate, labor market, and inflation.
All right, we got a red headline just crossing the Bloomberg terminal. The Kansas City Fed appoints Jeffrey R. Schmid as president and CEO. So, Molly, I guess if nothing else, it just gives a little clarity to our good friends out at the Kansas City Fed, because they're throwing a party later this month out in Jackson Hole.
Yeah, you invited?
I'm still waiting. It must be lost in the mail, the invite.
Same
but,
here.
It's big. So I guess this is important for the federal just to get that role filled.
Definitely, yeah. I mean, the Jackson Hole Symposium is like one of the bigger monetary policy events that we have in the, at least in the U.S., and it draws a lot of global policymakers as well. And this search has been going on for a while. So this is to replace Esther George, who announced her retirement last May, and that's due to mandatory retirement rules when she turned 65. So this has been going on for over a year now to try to find her replacement. I think we're all now probably furiously Googling who Jeffrey Schmid is and what his background is. It looks like he's a native of the Omaha area, so in the vicinity of Kansas City, and has, where was it? The Cox School of Business?
Yeah, SMU.
Yeah.
Yeah.
So definitely in that area of the country. We've been talking a lot more about the Upper East Side during this episode of the show, so I'll have to get myself a little up to speed on the Midwest.
Exactly. So, Stuart, we see news like this. As an economist here, what do you take away from this, other than this is just, the Fed kind of filling a key role?
Well, in filling this vacancy, it's more so a matter of what we think Schmid is going to be contributing in communication space, right? It's not as though he's going to be voting in this round of votes or in 2023, so it's not as though it's an imminent, it was a role that needed to be replaced with any sort of speed. What's far more important is how vocal he's going to be as either a hawk or a dove, and as folks dig into his background a little bit more, it's going to be more evident just where he is going to lie on that Fed spectrometer.
Yeah, it looks like he's also been at the FDIC, and that's a great point that you had there about how is he going to speak, as I'm trying to do as well, look up on what Jeffrey Schmid has ever said about monetary policy before. But, these Fed speakers, they talk a lot. And I wonder, from your perspective, Stu, do you think that is really adding more transparency to monetary policy here? Or do you think it makes people more confused when you've got 19 people in the Fed system who are talking all the time, and now we're all wondering what Jeffrey's going to add to that debate?
Number one is really what the Summary of Economic Projection shows. That's the communication tool that's the clarion call for what folks should expect from monetary policy in the years ahead. Communication in terms of public speeches is helpful, but only from the core members. Folks that are further out on the fringe do relatively little to sway what the median FOMC voter is going to do and what markets should then expect.
Interesting. All right. Stuart Paul, thank you so much. We appreciate it. Bloomberg Economics with us, giving us a sense there. Now we're going to go to an interview with Richard Francis, co-head of America's Sovereigns at Fitch Ratings. He sits down with our Sonali Basak. Let's head over to that interview right now.
Now we welcome in now our global television and radio audiences. I'm Sonali Basak, joined by Richard Francis. He's Fitch Ratings co-head of America's Sovereigns, who made the call on the U.S. downgrade. Richard, a lot of questions in the market. We've gotten past the initial debt ceiling dispute. Why now?
Well, we did right after the resolution of the debt ceiling with the Fiscal Responsibility Act, mind you, just 2 or 3 days ahead of the X date when they could possibly not make some kind of payments on its obligations. We indicated then that we would resolve the rating watch in the third quarter, and we wanted to take our time. We wanted to opine upon the impact of the Fiscal Responsibility Act itself on the deficits and on the debt level. We wanted to update our own numbers and look at where we think the fiscal trajectory and the debt is going. And we wanted to just take stock of the actual debt ceiling debate and its resolution as well. So we wanted to take our time and give a thoughtful analysis to both the fiscal picture and on the kind of governance issues and as well.
It's worth talking a little bit about the criteria you set out about a year ago, about what it would take to get to a downgrade, because some of the things have changed in terms of the picture. Let's start with the rise in debt to GDP ratio. The significant and sustained rise did not be so significant or sustained. So why is that not factored in here in terms of the decision made more recently?
Well, the debt level has been rising quite significantly. If you look at before the great financial crisis in 2007, debt to GDP was at below 60%. Now it's 113%. The 113% is almost 3 times higher than the AAA median, and it's more than twice as high as the AA median. So you've had a sustained, deterioration over the years. Yes, debt to GDP peaked during the pandemic at 120% and has come down, and that's because of inflation and high nominal GDP growth, and also the withdrawal of the stimulus, especially last year. But now we're seeing debt levels starting to rise again, and we do not see them stabilizing. We just see them continuing to rise. In the next 3 years, and probably more over the medium term. And that 113% is still 13 percentage points higher than where it was before the pandemic. So you've had quite a deterioration on the fiscal and debt side.
But what about the macroeconomic policy here, the performance and the prospects moving forward? Because in theory, this would have been improved a lot from where we were just a year ago. How is that factored in?
Well, I mean, obviously the macro picture is very important. We are still calling for a recession in the fourth quarter and first quarter of next year, a very mild recession. If that turns out to be if for whatever reason the U.S. is able to avert a recession, that's positive news, no doubt. But honestly, it doesn't really move the needle in terms of the underlying analysis. The deficits will remain high no matter what. And that the GDP is going to continue to rise no matter what. And so, yes, we recognize that one of the strengths of the U.S. is its dynamic economy. It's a large economy. The per capita income is high in the United States, and that obviously supports the tax base. That's actually is one of the key rating strengths. But I don't think it's enough to offset the deterioration we've seen on the fiscal and debt side.
I'd love for you to respond here to Treasury Secretary Janet Yellen, who said that she disagrees with your decision and that it is based on outdated and arbitrary, based on outdated data, I'm sorry. So if it is indeed based on outdated data, do you agree with that? And does that change the way that you look at the picture moving forward?
I understand why she's not happy with the downgrade. That makes sense. I think what she's referring to specifically are governance indicators that we use from the World Bank. They come out once a year. They tend to be a little bit backward looking. We use it because we have that data for every country in the world, and it comes out once a year, and we're able to use it for comparison's sake, and not just say it's Fitch coming up with this this underlying governance. So yes, it's a little bit backward looking, but I think more importantly, over the last 2 decades, you've seen again a deterioration in even these indicators. The United States started kind of at the top of governance, toward the top at 91 percentile, and now it's down to 78 percentile. So again, you've seen a kind of continuous deterioration over the last 2 decades.
What does this mean for the risk-free rate here? If the idea here is that treasuries are not as risk-free as they had been with a gold standard AAA rating here, what does this mean for broader markets? And do other countries, do other securities face further risk of downgrade given how much the treasury market had underpinned the financial markets?
You know, I think one of the rating strengths of the U.S., the other key rating strength in addition to the dynamic economy that I mentioned earlier, is the reserve currency status of the United States. It's unparalleled. There's not really much of an alternative. The treasury market's deep and liquid, and this gives the U.S. government tremendous financing flexibility. And I think that is a very key rating factor. And the other thing I would have to mention is, you know, AA plus is the second highest rating we have. It's not a low rating. It's not, you know, it's still a very high rating. It just we're just saying that we do not think that the underlying fiscal story and the governance, is compatible with AAA anymore.
Bring us inside the conversation you've been having with the Biden administration about this, given how heavily they disputed your decision.
Well, you know, I think, you know, part of the rating process that we have across all the sovereigns that we rate, we do have conversations. We do, obviously take, facts and figures and different things under consideration when we talk to them, and so that's not unusual. And it's a similar conversation we would have with any government.
We thank you for your time. That is Richard Francis. He is the Fitch Ratings co-head of America's Sovereigns and one of the people behind that big decision on the U.S. downgrade. Now, up next, Brendan Hayes of Guggenheim on private equity restructuring and leveraged loan markets. That default wave has been ticking higher. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. This Friday, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsbee, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street Week you won't want to miss. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio.
This is Bloomberg Markets, and I'm Shonali Basak. We're going to take a quick look at private equity firms because in the heat of earnings, shares of Carlyle are lower after distributable earnings tumbled 26% from a year earlier. This is as the firm is undertaking a line-by-line review of its businesses and working to impose more discipline on how it grows. Now we're going to shift over a little bit here because private equity is one space where there have been some bankruptcies. And we are going to talk to Brendan Hayes. He's the co-head of Capital Structure Advisory at Guggenheim Securities. If we take a look at the market here, you know, this is one day we're finally seeing some red on the screen. It's been pretty exuberant. If you take a look at spreads, high yield and investment grade, incredibly sanguine, but you're seeing a different story. What is kind of burning under the surface here?
Yeah, sure. Well, when you look back over the last 10, 15 years, pre-financial crisis, back when I was in leveraged finance, we used to structure loans to B2B credit ratings. What's happened over the last 5 to 10 years is there's been loosening of credit standards and quality, and so we've seen most of the market move to accepting B3, B- credits. So LBOs, whereas pre-financial crisis, if they got those ratings, were really hard to syndicate. The last 5 to 10 years, they've been syndicated to the point now where they make up roughly 30% of the market. So those, lower credit ratings, essentially lead to more defaults over time. We saw those companies in that credit ratings spectrum about a year ago have negative cash flow even before rates increased. Now we're seeing roughly 200 of those companies in that ratings category not able to cover their interests. So we see storm clouds ahead there.
So part of this is a function of higher interest rates. I'm wondering how much of this is a story about liquidity and liquidity constraints moving forward, especially with tightening, quantitative tightening moving forward. There's a question of, do markets get tighter from here? Does financing get harder to come by?
Financing is meaningfully more difficult for those lower credit quality companies. So we're helping those companies access the markets. It requires some creativity. We're working a lot with those sponsor-backed companies and some public companies on liability management. One of the reasons we renamed our group Capital Structure Advisory is we're looking at up and down.
Not because it's less scary?
Not at all. We're looking up and down the capital structure, including moving assets around and executing liability management with supportive lenders. In some cases, that's private credit, basically taking the place of CLOs who may not be interested in continuing to lend.
Well, that's an interesting question about the CLO market, because that's a story we haven't really doubled down on yet. How much capacity is there, and is there some concern here that you're not going to be able to offload leverage loans into the CLO market as you have in the past?
For sure. And again, it gets back to sort of the lower credit ratings and the fact that for those companies, it's really tough right now to place those in CLOs. So the newer CLOs that are being created are focused on higher credit quality names. In some cases, we're seeing private credit come in and replace that demand. But in many, we're going to have to use that sort of creativity of liability management and look to raise capital in other ways.
We are still seeing a jump in the 10-year and the 30-year, the kind of longer-term borrowing costs here rising. What does this mean for the companies that are borrowing today? You're seeing this downgrade for the United States, but the ripple effects, I'm wondering if the worst of the worst in the country are going to feel even more pain just because the U.S. sovereign is not necessarily worth what it was yesterday.
Yeah, well, it's not necessarily direct. Those pressures that increase rates just lead to higher overall borrowing costs for these levered companies, and they're already struggling. Not all of them, but even those that have, relatively healthy businesses, when you see rates rise from, less than 1% to over 5% now, that has a very meaningful impact. And you may not see, EBITDA growth, cash flow growth outstrip interest costs increase.
When do you see a meaningful tick up in restructurings, and when does it start to peak?
Yeah, we've seen some in 2023, but we really expect to see more going into 24 and 25. There are still some meaningful 25 maturities out there. And again, as companies continue to operate in a world where they can't cover their interest costs, they're going to need liquidity as they head into 24 and 25.
Brendan, thank you so much for your time. That is Brendan Hayes. He's the co-head of Capital Structure Advisory, formerly restructuring at Guggenheim Securities. Thank you.
Thanks.
Still ahead, Citigroup's Richard Zagab on the U.S. downgrade and its impact on investor sentiment. This is Bloomberg.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
This is Bloomberg Markets, and I'm Sonali Basak. Today, we've seen a meaningful move in credit in reaction to the U.S. downgrade. The cost to insure debt against default in the United States, Europe, and Asia are rising, reflecting a broad risk-off move in markets, plus a surge in Treasury yields, particularly on the longer end of the curve. Let's bring in Richard Zageb, who is the head of global debt capital markets at Citigroup. Richard, the reason I wanted to talk to you so badly today is because we have seen debt capital markets open back up. It was like all clear, no more recession, everything is fine, borrowing costs are peaking, and now you have this. How does this change the story?
I think it only has a marginal impact. I don't think it changes the story dramatically. Look, I don't think this is a complete surprise to anyone, right? Like, I think Fitch had actually signaled that they were thinking about doing this earlier this year when we had the standoff about the debt ceiling. And so I do, obviously it's had an impact on treasuries. I don't know that it's 100% related to this. The fact that the Treasury came out and said that they were increasing the size of the auction had an impact as well. So I don't think this is completely surprised. It's clearly a little bit of a hiccup. People are going to have to process it. It clearly takes borrowing costs up. But, there's so much liquidity out there. There is a real sense that the markets continue to be attractive, that inflation is under control, that any type of recession we have is going to be, modest. So I think, again, it's a small hiccup, but I don't think it really derails what is right now mostly a pretty benign environment for credit.
Now, another part of this is this idea that there are a number of corporations currently standing that are rated above the United States' rating by Fitch. And you have a number of them also at the same kind of group of ratings. What does this mean for anything that is rated above or at the same level as the United States, given this idea that can you even be worth more than or rated more highly than the sovereign that you're housed in?
Well, what's interesting, well, first of all, the bad news is that it's a very small group of companies that have ratings at or above, the current sovereign ratings for the U.S. government, right? The only AAA companies we have right now are Johnson & Johnson and Microsoft, right? We have a handful of others that are AA rated. So it's a really small universe. I do think those companies benefit because I think if you look back, a few years ago when we had the European sovereign crisis, what you saw there is a number of investors replaced sovereigns in their portfolio with multinational safe corporates. And I think you could see a little bit of that happen here as well. Unfortunately, the group of companies is small enough that you can't, there's only so much you can do, right? There's only so much of your portfolio that you can replace out of sovereigns into these multinational, highly rated corporates. But I do think there'll be some of that. What's interesting is even the companies that are rated higher than the U.S. government trade at yield spreads above the U.S. government, even after the downgrade. So, again, I do think they will benefit. I wish there were more of them, but the small number that are out there will definitely benefit. And I think they will. You could see their spreads tighten to the U.S. government, to U.S. Treasuries. but I think they'll continue to trade at a spread, a modest one, but a spread.
What about the companies that are riskier? If you're below the U.S. government and you have a perceived riskiness in the United States now that didn't exist as much before, does that spell bad news for anything right under AA?
Look, I think it absolutely impacts borrowing costs across the board, right? Like there's, if you have this downgrade, if the U.S. government isn't pristine, then that's going to ripple through the entire corporate sector in the U.S. It just has to, right? Like there's just no question about it. But again, I think this downgrade exacerbates a problem we already have, right? The Treasury needs to raise an enormous amount of money. Again, as the slide you put up there in terms of the size of the auctions coming up, that's a lot of money that has to be raised. It's more than has been raised in a while. That is going to, government's probably going to have to pay more for that. That's going to then translate into higher costs for investment-grade corporates and even higher costs for non-investment-grade corporates. So I think the biggest impact is an increase in borrowing costs. And the question is, are those costs so high that some of the more speculative credits are going to have problems covering their interest and staying out of default and maintaining liquidity?
Richard Zogeb, Head of Debt Capital Markets globally over at Citigroup. Thank you for joining us today on a pretty historic day over here in the bond market. Coming up, Charles Myers is joining us to talk about the market and political implications of the U.S. downgrade. Stick around. It's going to be a great conversation. We're going to give you the 360 on what all of this means. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
I'm John Olkin. Welcome to Bloomberg Markets.
Matt Miller is off today. Let's get a quick check on the markets here, John, because we are still looking at an S&P not quite at session lows, but near session lows, down about 1% or so, 1.2%. We are also looking at a 10-year yield. It's not rising as high as it was earlier in the day, where we saw a little bit higher of a jump here, only about 4 basis points higher in the day, about 4.06 on the day. The dollar, though, now getting a lift at about 1.2226 on the Bloomberg Dollar Index. That is about a 0.32% jump on the day. Again, it's not a huge lift, but dollar strength again is reversing a trend that we've been seeing more lately. Lastly, I want to hit on crude really quickly because we are seeing crude over at $79, a little bit of a reprieve here in the oil market.
Yeah, very quickly eating into some of those big gains, Shanali, that we saw for energy and energy stocks in the month of July. And broadly speaking, a cautious tone for most individual names. We do have a lot of earnings stories that the market continues to chew on, though. Starbucks, even though the top-line performance, according to some analysts, could have been stronger, they're finding some ways, including through price hikes, to improve the profit picture. CVS talking about through rising costs over the next couple of years, possibly impacting profit, but in the current quarter, the sales were relatively strong. And then let's talk a little tech, Shanali, because huge gains this year for chip makers, whether it's NVIDIA or AMD, and a lot of technology stocks are getting caught up in the sell-off today. Now, AMD overnight had some relatively strong numbers, but again, stocks had such a huge move already this year. It's down about 6% right now, and Shopify also down about 6%. We'll be watching for that e-commerce company's results a little bit later after the bell today.
Now, the big topic of discussion on Wall Street is that impact of that Fitch downgrade on the U.S. sovereign debt. Charles Myers is chairman and founder of Signum Global, who also served on both Barack Obama and Hillary Clinton's presidential campaigns, so he knows a few things about politics. So, Charles, thank you for joining us today, because if you take a look at the impact, even if you don't see very sharp moves along the entire curve when you look at the Treasury market, when you boil it down, what are the most significant implications?
Look, I mean, I think a downgrade obviously is not good news, but any sort of impact in the short term is what we're seeing today. A little bit of a risk-off move. Frankly, I think the market was overbought. The AI rally has taken the U.S. equity market to highs that, are probably, a little overdone. And this is, in a way, an excuse to maybe even take some profits. But more broadly speaking, I think what Fitch is really trying to highlight, and I agree with them, by the way, is that the fiscal management or mismanagement of our economy and the overall debt burden are two medium to long-term structural problems for the U.S. And I think that that's the bigger implication of the call today.
I also should be giving you kind of a victory lap here, because it was you last year during the midterms that had mentioned to me that this was going to become an issue this year. And I said so, and everyone gave me a hard time, and then it became an issue. So the debt ceiling limit issue had gone to the wayside. We have now this downgrade, and then you have budget discussions again that come up in October. How much of an issue will that become?
So I think that, we got through the debt ceiling, which was good news, kind of down to the wire as we expected, but we got through it. Now we have to get through the budgeting process, and I do think there's at least a 90 or 95% chance that we're going to go into a government shutdown in October. This isn't really on investors' radar right now because it's August and Congress is also out of session, so it's a little quiet in Washington. But we are heading up for a pretty big fight, unfortunately, over the budget. I do think we go into a government shutdown, and the markets tend to be relatively sanguine about a government shutdown unless they go to about a month or longer. And I think in this instance, the chance of that happening is higher because the Freedom Caucus is very upset about the way that the debt ceiling was resolved, and they've already indicated quite publicly they're going to act out through the budgeting process and force a shutdown.
Charles, if we have yet another test right around the corner, what is the reaction in Washington if a debt rating agency essentially is pointing to political squabbling as the reason for a rating agency change? Do you think it's going to change behavior in D.C.?
Unfortunately not. The members of Congress don't watch the markets closely, so often don't even watch the markets at all unless the markets are, in free fall or there's a major correction. So I don't think it's going to change political behavior, unfortunately. A lot of the spotlight now is on Moody's, because if Moody's also downgrade, then maybe that'll really catch the attention of people on Capitol Hill. But for the most part, fiscal responsibility is an issue that does resonate with voters. Of course, it's an important issue. It resonates. But in fact, issues around the debt ceiling or the deficit really don't play into our elections. So I don't see it becoming a major issue in the election next year, and therefore I don't see Congress really changing or finding ways to work more collaboratively or better in a bipartisan way to resolve these issues, including the upcoming budget fight in September, October.
Well, you mentioned Moody's. What do you think are the determining factors when you have one debt rating agency that makes a change to see more change coming?
It's a tough call. You can never predict what the rating agencies are going to do. In the case of Fitch, though, they were very clear. They lowered the outlook on the sovereign back in May. We're very clear on the reasons, that they did that and why they're concerned. And I think that their downgrade last night was entirely consistent with everything they've been putting out since then. On Moody's, again, we'll have to wait and see what they do. But they're now the lone AAA rating on the sovereign, and I think there's going to be a lot of attention and really people watching them very closely to see what they do.
Well, to the point you were making about the political fallout and whether politicians even pay attention and change the way they behave around a decision like this, can this situation get materially worse? I mean, Fitch was really making their decision off of months and years of behavior, decades of decisions. And so how does that change the trajectory that has been bad? I mean, I don't think there's any other way to put it.
Yeah, I couldn't agree more. Look, I mean, forcing the country to the edge of default, right, which happens almost, every time, or not almost, nearly every time we get, close, we have to lift the debt ceiling, and also forcing the government into a government shutdown around the budgeting process. Both of those are really no way to manage the largest economy in the world. It's just complete fiscal mismanagement. But again, I don't see the behavior changing. I think it would really take a government shutdown for a long period in October, which is not our base case, but something like that, and a major market correction. Then we're going to deal with the debt ceiling again in January of 2025. If we do get to the brink or worse over and do go over the X date, perhaps that would change behavior. But Washington is so deeply divided. Unfortunately, it's incredibly partisan, and I don't see behavior changing even with this downgrade last night, unfortunately.
Hang on that for a second. You mentioned major market correction that could come in and around October relative to these debt discussions, this budget discussion that you're seeing over in Washington. How could that play out?
Well, I think, the only times, again, as I mentioned earlier, the only time markets get really concerned about a shutdown is if they go on for a month or longer. Because what happens is not only do you have to furlough all, government employees, you actually have to stop, literally, it's almost like a default. You have to stop paying on government contracts. You have to stop, it really has, starts to have implications for the economy if it goes on for a month or longer. So it would need to be a couple months shutdown, before I think the markets really got concerned. We'll see, if we actually get there. But again, as I said, I'm just not optimistic that the two sides can get their act together and really tackle what needs to happen to be able to address these fiscal issues. And lastly, Fitch is absolutely right to be pointing out our debt to GDP, is almost 3 times the average of the other AAA rated countries. I mean, that also is a long-term structural problem. So we're all going to be talking about the deficit going forward. Finally, I think it's long overdue, and I think we need to find ways to cut some spending and address our debt issues.
Well, you talked about the stock market reaction today, and perhaps investors were looking for a reason to sell equities or high-flying AI-related stocks. It is interesting, though, the timing here, Charles, as we've been navigating through worries about the economy that have actually been lessening. You had quite literally the chair of the U.S. Federal Reserve saying his economics team no longer forecasting a recession. On Wall Street, Bank of America becomes the first big player, really, to say we no longer see a recession. So even though Fitch itself, and it'd be great to get your perspective on what they said about the economy, is pointing to several specific factors for the debt downgrade, it feels like the market was getting around to the idea that, okay, after all these interest rate hikes, maybe this soft landing scenario is the reality going forward.
Yeah, I'd say the markets absolutely have been pricing in a soft landing or increasingly no landing, no recession. We're still in the hard landing camp. I think that what the markets are mispricing, I actually think the U.S. equity market in particular, but the U.S. financial markets are mispricing risk, probably more than, any time in the last 2 years, in part because we have huge credit events coming. One of your previous guests was just talking about how it's harder to get financing for companies. And I think, whether it's commercial real estate, some retailers, fintech, we're going to see some pretty big blow-ups, some pretty big credit events over the next 6 months. Yes, the labor market's very strong, but the consumer, I think, is actually a little more tapped out. They've been taking on record amounts of revolving credit to keep their spending up, and they've got to start making their student loan payments again starting October 1. So I think we're in for a little bit of a bumpy ride in the economy, certainly more than what's priced in today, and certainly the downgrade last night doesn't help. I do think it actually does increase borrowing costs at the margin, but really for companies that need access to credit the most.
Charles Myers, chairman and founder of Signum Global, we really thank you for bringing this all into perspective. Now, coming up next, Robin Hood reports after the bell. It's our stock of the hour. It's up next. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Markets. I'm John Oakman with Sonali Basak. Time now for our stock of the hour. Robinhood has been in rally mode over the past month, but that momentum will be put to the test when the company reports earnings later today. We are already seeing the stock under some pressure today by about 4%. Now, Robinhood, of course, rode a wave of excitement during the meme stock era, Sonali, but after customer growth cooled off, they had to focus on new offerings like retirement accounts, 24-hour trading, or after-hour trading, I should say, as well as cost cutting, which just about every company has had to focus on these days.
Absolutely. That is a lot of things to focus on at the same time. We are going to talk to Devin Ryan, who's a senior research analyst at JMP Securities, who's had a bullish rating on the company and a $25 price target. Devin, if you take a look at the current kind of earnings cycle for Robinhood, do you think they'll face some significant challenges before things start to get better? I mean, they've already had an almost 52% stock jump this year.
Yeah, hey, Sonali. Hey, John. I think we're getting on the other side of the challenges. So, as you guys highlighted, 2021 was a record year. The first half particularly was incredibly strong. And that wasn't a normal environment with the meme stock backdrop and people still kind of finishing up working from home. And then in the last 18 months, we've kind of been in the opposite environment where activity has been very subdued. There's been a lot of macro uncertainty. There's been a war. Interest rates have moved faster than we've seen before. And so if you're thinking about investing in that market, it's challenging. And so people have been really sitting on the sidelines. And so our view is that you're starting to see some early signs of green shoots in the macro backdrop. Equity markets are obviously behaving better as well. And so I think that's what today's earnings are going to be more about. I think Robinhood has gotten their expenses under control, and now the revenue environment is starting to get a little bit better. And now we're very cash positive, and the next point for them is kind of getting to GAAP profitability. And I think we're right on the verge of that, and we'll hear about that tonight, I think.
And Devin, to your point, when you go from making most of your money based off of transactions, the idea of making money off of, let's say, deposits, how would you characterize how that has gone?
Well, it's going incredibly well. So you think about revenues this quarter are probably going to grow about 50% year over year. And a lot of that is coming from net interest related revenue. And that really just highlights that there is some diversification of this business model. You see that at firms like Schwab and some of the other kind of more incumbent firms. But it's good to have a balance in how you make money. And so you're going to see that come through this quarter. The other thing is because they are kind of a newer, challenging fintech firm, they pass on a lot of the benefit of higher interest rates to their customers. So that's been a big driver of deposit growth. So their net new assets, their deposit asset growth is trending at over 20% annualized, and I think it will be again this quarter. So you're looking at 20 to 25% in net new asset growth, which compares to mid-single digits of some of the kind of incumbent firms. So when I think about the health of their business, they're doing fine. It's a little bit more of this kind of macro overhang that has really, I think, been the friction point over the last 18 months. And again, I think we're starting to get on the other side of that. And then the last point is some of these newer initiatives are really starting to gain some steam. So fully paid securities lending, early withdrawals, they highlighted we're tracking up 50% on revenues, even from the beginning of the year. So it'll be good to get an update there. They've launched retirement accounts, which is gaining traction. They're starting to do M&A as well. They just announced the acquisition of a small credit card company. So I think those are all things that we're going to care about tonight. Less about the earnings, because I think you'll get a fine quarter, but it's more about what's coming next and then kind of this path to profitability, which, as you guys identified, all investors are very much focused on today.
Right. I mean, how much do you expect them to really give you a roadmap on profitability and kind of these growth initiatives here? Because in theory, credit cards, young consumers, net interest income, the possibility there could be interesting. The question is, how fast do they actually capitalize on it?
Yeah, so I think two things. One, the expense side of the story has been huge, and so that's been the big driver of kind of getting to that cash profitability and then next GAAP profitability. The other piece will be just early green shoots of some recovery in retail sentiment. That's just the traditional business that they've been in for, from the beginning. It's starting to see some signs of normalization there, because this is not a normal environment, as I just mentioned. And then, to your point, Sonali, getting some update on these newer initiatives, which again, they will take time to really move the needle, but you have to start somewhere. And some of these businesses I mentioned are growing 50%, even over the past couple of quarters here. So you're going to see some really strong growth. So that will start to catch up and be material, in our opinion. I think you'll get a good update on that tonight.
Devin, we're almost out of time. This stock would have to climb sizably to get back to those previous all-time highs. We'll see what happens on that front. But I do want to get your perspective on the SEC's crackdown on the crypto industry. We've covered it a lot from many different angles. What does it mean in terms of this particular business? What are you watching on that front?
Yeah, I think the big question is around what is a security, what's not a security. Obviously, everybody paid close attention to the Ripple summary judgment recently. It has an implication. Robinhood, crypto is single digits of their business model, so it's not as big of a driver. But I think we absolutely need more clarity around how regulators are thinking. And what I'm really looking for is action out of DC. So I think what's happening in the courts is actually driving a little bit of momentum in DC, and we need the lawmakers to actually drive legislation that's going to help the regulators enact the regulation. So I think that's what we're looking for to come next year, and there's actually been some promising developments there even over the past few weeks. So I'd pay attention to that.
Okay, helpful context. Devin, thanks a lot. Devin Ryan with a great preview as we wait those Hood results later. He's with JMP Securities. When we come back, the 2023 rally in the S&P 500 taking a hit today as we sit near the session lows, but we'll talk about what some of the data behind the scenes is telling the Bloomberg intelligence team. We'll be right back with more on that. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Markets. I'm John Olickman with Sonali Basak, and the Bloomberg Intelligence Market Pulse Index has pushed now to what they're describing as manic levels, an early sign the equity rally might be getting a bit overheated, possibly due for some consolidation. Let's bring in Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams, who has so many ways to slice and dice the market. But this is great data, Gina, considering that now that we've seen this big rally, and sometimes when you're in the momentum mode, you can see pullbacks. These indicators can help. What are they telling you?
Yeah, so we developed the Market Pulse Index actually just to give us a composite indicator of what sentiment inside the equity market itself indicates for the near-term future. And historically, the indicator hits near zero at absolute levels of panic. It hit that panic level back in late September when we published on it in early October. It's now at what we would call manic at a level of 0.75. It rates 6 different indicators together, creates a composite on a score of 0 to 1. And Anything nearing 1, anything generally above 0.7, we would consider mania and an area of opportunity to potentially shift a little bit more defensively, or may indicate a consolidation phase coming in stocks. And we got that again. As of July, the indicator did hit some version of mania, very similar to what we got back in January, hinting at a consolidation phase coming for stocks at large.
It's interesting because the language here really plays to all my vices here, that they, the manic, greedy weaknesses all around. I mean, I'm wondering what this idea of overheating really means in terms of how deep any correction might be.
Yeah, I think it's a really good point. It actually does not indicate correction at all. It just indicates a period of consolidation. Historically, what we find is your average 3-month performance after a manic reading of 0.75 or above results in about a 2% gain over the next 3 months. Whereas after panic readings on the index, your average gain over the next 3 months is much closer to 10%. So it simply indicates a likely slowdown. And, sentiment is very good at indicating complete washout points in the equity market, which is why we developed this survey. Sentiment is much harder to use as a topping indicator for the equity market, as is indicative. If you look at the graph, you see that equity markets tend to concentrate in a more manic phase or a more optimistic phase, as stock prices do tend to rise over long periods of time. Nonetheless, it can give us a hint that maybe overheated conditions have emerged. And we did see that also emerge with RSI. 14-day price momentum in terms of the RSI did hit a critical level of 70 over the course of July, and that does usually indicate that stocks are a bit overheated, maybe due for a consolidation phase, but really doesn't give us any indication of a topping formation. So regrettably, I can't give you that degree of precision.
All right, helpful context, though, on the broader themes, and I know you and the team are also watching some of the money that has been flowing to potentially other sectors as we watch this transition, like the industrial. Shanali, Gina Martin-Adams joining us there. But for today, yes, we are certainly seeing a consolidation, aren't we? Watching those markets pull back in the second trading session here of August.
Yeah, it's interesting. You are watching just a little bit of pullback there in the S&P and the NASDAQ. You wonder how much of this is pure risk off or how much of it is that yield story. Let's see, John.
All right, well, we will find out, obviously, as we roll through the week. For Shanali, I'm John Ehrlichman. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
A surge in yields, sour sentiment for stocks. Live from Studio 2 at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. And to put it mildly, you have markets kind of puking right now. You look at the S&P 500 off by about 1.3%. The NASDAQ 100 off by more than 2%. It's big tech leading the declines here. We did get some hot ADP figures this morning showing that private hiring remains robust and then some. We also have yields rising today as bonds sell off. 10-year Treasury yields currently up about 5 basis points or so, well above 4% at this point. Of course, this comes on the heels of that downgrade by Fitch of the U.S., stripping the U.S. of its top-tier rating. And of course, we also got the Treasury's long-awaited refunding announcement coming in a little heftier than analysts had expected. So a lot of supply coming to the Treasury market. You add it all together, you are seeing the VIX actually rise for once, Romaine. The VIX currently at about 16.
Yeah, and all it did was, well, it took just a downgrade here of the U.S.'s AAA credit rating. It really was the downgrade derided around the world. Fitch cutting that rating down to AA+. The culmination of a months-long review, really sparked, of course, by all of the political hullabaloo over the debt ceiling debate. A debt ceiling debate that, of course, at some point was actually resolved. But, of course, that political standoff, apparently the main reason why Fitch decided that it was going to downgrade. The reaction in markets somewhat muted, but the criticism over the methodology was anything but. Whether the response was a shrug, a scoff, or just a scowl, the consensus opinion seemed to be, why now, Fitch? Why? Here's what they had to say.
AA+ is the second highest rating we have. It's not a low rating. It's not, it's still a very high rating. It just we're just saying that we do not think that the underlying fiscal story and the governance is compatible with AAA anymore.
Richard Francis, of course, one of the people leading the team that, of course, led to that downgrade a little bit later today. We're actually going to speak with a couple of folks who were on the team over at S&P back in 2011 when they did the downgrade there. But a big part of the reason why we got the downgrade today, of course, has to do with what we saw on the screen behind me here. Now, that announcement came just mere hours before Janet Yellen and her team decided to test the appetite of Treasury dealers for an increase in debt issuance. The U.S. Treasury boosting the size of its quarterly sales of longer-term debt for the first time in more than 2.5 years, an announcement that did spark a sell-off in Treasury that sent 10-year yields to the highest going back to November. The 30-year yield now up more than 19 basis points just over the past 2 days. And that wasn't enough drama, Katie Greifeld. I'm told there's some changes at the Fed as well, at least over at the Kansas City Fed.
The Kansas City Fed, we finally have a successor to Esther George. Of course, her retirement announcement was announced over a year ago at that point. And now we know that Jeffrey Schmid will take over. He's a former banker currently at the Southern Methodist University. He'll start on August 21st. Really interesting time for the Fed. It comes just weeks after we did get that downgrade. And to go back to why Fitch made this move now, it's pretty interesting. It all comes down to the U.S. debt trajectory, which has really exploded higher over the last several years. You can see here this debt mountain, if you will. It's a pretty hefty one to scale. And you can see in white here, you have the debt servicing costs have increased dramatically since the Fed started raising interest rates last March. And it's a much different picture than we were in back in 2011 or so, Romaine, when we saw S&P go ahead with that downgrade. So the lines tell the whole story here.
All right, let's get right to Michael McKee, our Bloomberg economics and policy correspondent here. Let's start off, Mike, of course, with that announcement at the Kansas City Fed. An announcement, of course, that we knew was a long time in the making. We just finally learned who it's going to be.
We did. Jeffrey Schmidt is like his two predecessors at the Kansas City Fed, a former bank examiner. He started there in 1981 at the FDIC, actually, in Kansas City, but worked his way up through the banking business to the point where he was running Mutual of Omaha and American National Bank in Omaha, and then a family-owned bank down in Dallas before he ended up at SMU. He will take office, as Katie mentioned, on the 21st of August, which is 3 days before the Fed's, Kansas City Fed's Economic Symposium in Jackson Hole starts. So it's going to be interesting to hear from him when he gets there about what he thinks of economic policy, since he's not an economist. He's a banker.
And of course, he will be a voting member in 2025, I believe. And as you said, we really don't know which way he necessarily leans. A bit of a wild card to add to this FOMC.
He hasn't got a trail of monetary policy opinions, so it's going to be hard to pin him down for now. However, by the time he does vote, we should know enough about him, because he will have opportunities to talk about what he's thinking in many times, including at the Economic Symposium in Jackson Hole. So it's going to be interesting. Leaves one vacancy still open, and that is the St. Louis Fed, Jim Bullard, announcing late last month that he was stepping down. So Katie, Romaine, you could get your resumes in. I think there's probably still time.
Yeah, we might have a fighting chance here. Of course, Mike, we have to address the elephant in the room, which, of course, was the big downgrade by Fitch late yesterday here. The market, I guess, taking it in stride here, but there are, I guess, some broader questions here about the response by the government, both the government and the White House, and, of course, the actual fiscal policy makers in Congress.
Well, the problem is you're not going to get any action from the fiscal policy makers in Congress. They already showed us that with the debt ceiling debate. They did come to an agreement, but there were a lot of people up on Capitol Hill who thought maybe we should try a default. And now they're talking about a government shutdown come the end of September, which all figured into what Fitch said. But does it make any difference to the overall U.S. economy? Not really. It's the largest debt market in the world, very transparent, and there isn't really much of an alternative. You can add the next 10 government bond markets together, and you don't get the size of the U.S. Treasury market.
Absolutely. Michael McKee there helping break down two of the top stories this afternoon as we kick you off to the closing bells. Just about 2 hours to go here, and there are some jitters out there through the market. We should point that out, that stocks across the board are in the red. Of course, coming off what had been a phenomenal month of July, and quite frankly, a pretty phenomenal 7 months to start the year. Cambria Investments CIO Meb Faber joining us right now. Meb, great to catch up with you once again. I don't know about the market or the market sentiment. Based on what we saw in the first 6-7 months of the year, there is a kind of sense here that maybe the best is already behind us.
You know, it's not just been a great 7 months, man. It's been a great 7 years. It's been a great 10 years. It's been a great 15 years in U.S. stocks. It's been it's a beautiful day at the beach. Everybody, market's up double digits. I don't know if anybody's watching. I hope they're watching us. But look, the U.S. stock market's been the only game in town for as long as most people can remember. If you look back, it's compounded double-digit returns since the GFC, right, for the last decade. That's awesome. Everybody's got all their money in U.S. stocks. God bless them. Pat yourself on the back. Here's the problem. If you look back for the past 100 years, there's been 4 times in history where the trailing 10-year returns peak out where they are right now. Ditto for what we would call the risk-adjusted returns, or the Sharpe ratio. Sharpe ratio is above 1 or somewhat unheard of, right? Most asset classes around 0.2, 0.3. There's been 4 times in history where the U.S. stock market's trailing 10-year Sharpe ratio has been above 1. It happened in the 1920s, the Roaring 20s. It happened in the nifty 50s bull market. It happened in my favorite bubble, the internet bubble, 2000 peaking. And then it happened in this last period, whatever you want to call it, the COVID meme stock era, where Sharpe ratio is above 1, double-digit compounded returns, 12, 15% at some points. The bad news is in the other 3 instances, stock returns were very muted going forward. You had the Great Depression, you had the inflationary 1970s, the internet bubble burst.
Yeah.
Who knows what comes next, but on average, high stock valuations for the market cap in the U.S., particularly the really expensive ones, lead to, unfortunately, poor stock returns going forward.
Is there anything out there when you sort of look at, I guess, just the changes that we've seen in rates, that whatever way you want to call it, a normalization, if you will, and just kind of the more structural changes in the economic cycle that may not actually be a cycle and might be here to stay, Meb? Does that change the outlook? Does that change, I guess, the models?
There's two things, and this is unpopular. It's like being in the desert, you know, having no water, cacti all around, and being what's called a value investor. Equally as unpopular as being a value investor is being an international investor. Now, if you look at the opportunity set, we have one of the best opportunity sets for value ever in the U.S. So if you look at a lot of the value type of strategies, overweight things like financials, materials, energy in the U.S., we're talking single-digit PE ratios versus double, triple, quadruple the valuations for the broad market cap weight. Now, the good news is you can hang out. It's a very similar vibe to me as late 90s, early 2000s. You can hang out and probably be totally fine in those equities. You can also go outside of our borders. Foreign developed, foreign emerging, market cap weight, totally reasonable, emerging cheap. But the cheap stuff there is also screaming cheap. Single-digit PE ratios, high dividend yields, high buyback yields. Now, what's interesting in the emerging markets, there's one sector that's our number one allocation, that's tiny allocation in the U.S., which is technology. And a lot of that is because emerging markets have been pummeled over the past decade, left behind as the U.S. has creamed everything in sight. So there's two things you can do. One is you can tilt towards value. The other is you can move outside our borders. Of course, I've been saying this on this show for a little while, so my timing is not exact. But I think for the next decade, when we check back in with you guys in 2033, my guess is that both of those will be hugely additive in one of the better trades of our lifetime.
And Meb, it pains me to say we only have about 30, 40 seconds back with you, so we have to have you back before 2033. But you mentioned that yield, dividend yield, shareholder yields. It seems like even in this market, even with tech stocks, you know, rallying to the degree that they have, that there's still a hunt for yield within the equity market.
Dividend yield is largely meaningless, and I know that's not popular with the FIRE crowd, passive income crowd, but you have to account for share buybacks. And everyone focuses on buybacks. Their brain goes crazy when they hear the word buyback, but equally as important is accounting for share issuance. And who's been terrible about this in the last 5 years? The tech stocks with massive amounts of stock-based compensation. Look at Snap, my goodness. So if you do a dividend strategy, my God, you have to do two things. You have to include value, or you have to include stock buybacks and share issuance. If you don't, you're in a whole host of trouble. That's why we talk about shareholder yield, a much more holistic measure. You end up with double-digit yields in the U.S. and abroad. Much better place to be that also trades at super cheap valuations.
Meb, always great to talk to you. Have to get you back on more often. Meb Faber there.
Have a great summer, guys.
Absolutely. CIO over at Cambria Investments. A lot more coming up on the program. Michael Saylor up next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time
to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Let's get to the latest results from MicroStrategy. The enterprise software maker, which you probably know is the largest publicly traded holder of Bitcoin, returned to profitability in the second quarter. And I'm pleased to say that joining us now is MicroStrategy Executive Chairman Michael Saylor. Michael, great to have you with us. If I look at MicroStrategy's total Bitcoin holdings right now, currently stands at nearly 153,000 Bitcoin. Nearly 500 of that came just since June 30th. When you think about the Bitcoin acquiring strategy, what might that number total in the quarters to come?
Well, our goal is to accumulate as much Bitcoin as we can on behalf of our shareholders. And, we acquired from cash flows. We bought that last tranche with $14.4 million worth of company cash. We also use equity and debt issuances from time to time. So we try to make sure that everything we do is always accretive. So we will acquire as much Bitcoin as we can as long as market conditions allow us to do it in a creative way for our common stock shareholders.
Well, it was interesting that we also saw an 8K come out after the earnings report yesterday, which seems like a way to really tap into the rally that we've seen in the shares so far this year. I believe MicroStrategy up over 200%. What's the plan there? What will you use that theoretically for if you do sell shares?
Our primary use of proceeds generally is just to acquire Bitcoin. So Bitcoin is up 145% since August 10th of 2020, 3 years ago when we started on the strategy. And we've pursued a strategy of levered Bitcoin investments. So we use cheap capital. Our average cost of capital is like 1.6% or something in that range. And the combination of leverage and then offering our shareholders a yield. We don't charge them a fee to manage this Bitcoin. We actually aim to generate a yield. That's allowed us to actually generate 254% performance in the same time that Bitcoin was up 145%. So our strategy is sort of levered long, offer a yield, don't charge a fee, and then actively manage our position and actively manage acquisitions and financings between equity, debt, and cash flows in order to get the best result for our shareholders.
So for those shareholders, for those investors, the attractiveness of that strategy, does it change at all, Michael, if you do get a much larger ecosystem of ETFs and other investable crypto products?
Well, I think a spot ETF would be ideal for the market. A spot ETF will allow large hedge funds and sovereigns to come into the space with billions and billions of dollars and track the asset. MicroStrategy doesn't charge a fee, and we actively manage the business to generate a yield, and we use leverage, and we can actually tap into leverage because we're an operating company that an ETF couldn't do. So we view it as being really beneficial to the entire ecosystem. We don't have a capital structure that would allow for tens of billions of dollars to be invested in Bitcoin. Mm-hmm. So we're a unique instrument. We're that sports car, and the ETFs, the spot ETF is going to be like super tanker.
And we'll see if that crosses the line. Of course, there's been many attempts made before, but I do want to go into what's happening in MicroStrategy shares, because I just checked, year to date up 186%, so not quite 200%. But you compare that to what Bitcoin has done in 2023. Bitcoin is only up 75%. The fact that MicroStrategy has rallied so much more than Bitcoin itself, how do you explain that? And unfortunately, we only have about 30 seconds left.
Well, Bitcoin is the house everybody wants, but it's in a foreign country, and you have to pay cash to buy it. It takes about a year, and you can't rent it and mortgage it. MicroStrategy is that same house in the best neighborhood with 10,000 acres of ranch land attached to it, and we can generate a yield, and you can actually buy it financed by your local bank, right? We're a compliant security. So if you're an institutional investor and you're looking for an easy way to get Bitcoin exposure that doesn't charge you a fee, that is financeable, that is good collateral, then MicroStrategy is pretty compelling right now. And I think that it's important to point out that we will always be differentiated from the ETFs because they can never offer leverage. They have no yield. They have limited hedging options. They're not diversified, and they charge a fee.
All right, Michael, got to leave it there. Really appreciate your time from MicroStrategy Executive Chairman Michael Saylor. Thank you. From New York, this is Bloomberg.
And money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Welcome back. Taking a look at shares of Teva Pharmaceutical having their best day going back to July of last year. This after their second quarter revenue results came in earlier this morning, and investors seem to be pleased. A beat on some of the key metrics here and targets going forward, giving investors some optimism that the guidance by their CEO, Richard Francis, is still intact. Pleased to say that Richard joins us right now to talk a little bit more about that. And I do want to start off, Richard, with that forecast going forward, particularly when it comes to adjusted EBITDA and your ability to hit those targets.
Yeah, well, firstly, thank you for having me on the program. Really appreciate that. So what you've seen with quarter two is an acceleration of our innovative portfolio. And so we have 51% growth in Austedo, which is significant. And